trading, here are your headlines. The cash trade then in focus as we tell you what's happening over in China. Chinese concerns still dominating, but global investors also waiting for the Fed to make its interest rate decision today and give us any clues on tapering. A beat for big tech fails to impress Wall Street. Apple sees record third-quarter sales, but slides post-market after warning of slowing growth. And it's a huge day for earnings here in Europe. We'll bring you our interviews with the CEOs of Man Group and Capgemini. Welcome back to the European Market Open, the second hour of programming. Man Group and Capgemini still lie ahead. We've had plenty of corporate contributions already through the first hour of this program. And before that, in Daybreak Europe as well, the CEO of Deutsche Bank speaking to me a little bit earlier on. And we've had a host of other executives talking us through their earnings as we are fully into earnings season. That is part of the influence as we look at European futures. That is part of what we're dealing with here on the European equity markets. Also dealing with, of course, the hangover once again from heavy selling through the Chinese session. The Hong Kong market managing to pick up a little bit into the last hour of its trading day now. Chinese equity markets, though, closing in the red. We're down 0.6% on Shanghai Composite. We managed a little bit of a bounce on the CSI 300, 0.2% to the upside by the close, and the Chinex also a little positive, but it had been earlier on trading in negative territory, and concerns do still remain, it seems, around that China narrative, despite reassurance coming from local Chinese media. So European equity markets focus, as I say, on the earnings story and the Fed and the Chinese story. And with all of that in mind, we make some modest gains to the upside. So the Stock 600 up by 0.1%, the FTSE down by around 0.1%, the CAC 40 and the IBEX both up around 1 or 0.2%. So we're making some modest gains, waiting for a few of the big financial heavyweights that reported today to actually open up. Don't have an opening price on Barclays or Deutsche Bank just yet. We'll bring those to you as soon as we get them, of course. One of the key events that we're focusing in on today is the Fed in focus, because the outlook for bond buying is going to be much discussed, as well as the commentary around the risks from the Delta variant and inflation. Let's get into a conversation with about that then with Callum Pickering, Berenberg senior economist, who's with us this hour. Callum, very nice to have you with me. So I suppose the big picture question will be whether we get any clues on the tapering, whether you're preparing for something of a hawkish surprise from the Fed or not.
I think it would be a surprise today if the Fed were hawkish. They may wait until Jackson Hole, late August, before they start signaling anything on tapering. There are just a few risks emerging in markets, whether it's the virus uncertainty, whether it's that direction of some economic data. So the Fed probably holds off today. But the question is, when do they have the serious discussion about inflation risks? For now, the Fed is presuming, much like other major central banks, that this current bump in inflation will fade, and we will quickly, starting next year and into 2023, return to that post-Lehman new normal of subdued low inflation. And on that basis, the Fed can actually justify its very ultra easy monetary stance. But I think actually looking at the fundamentals, the inflation risks are starting to tilt up to the upside over the long run, and hence the Fed at some point is going to have to adjust its view and its policy in line with that.
Yes, and talking about inflation, I was looking at some analysis of the results season in the US yesterday, Callum, and taking it from the micro to the macro, I wonder how this sits with you. Results from industrial heavyweights like 3M, Rockwell, Stanley Black & Decker, all of these sort of household names when it comes to industrials and the household. They're increasing prices, but the thing is, some of them are saying they can't increase prices fast enough. They can't quite keep up with the cost pressures that they are facing. I wonder where that sits with your expectations around how long-lasting, how enduring, crucially, the inflation impulse is.
We have some significant short-term demand-supply imbalances at a time when economic momentum is strong and firms believe that they have pricing power. Also, on the labor side, some workers actually believe they have wage bargaining power, and hence what we're seeing now is the start of a good old-fashioned wage price cycle. Now, the outlook for inflation is not a straight line. I think it's highly unlikely that we see these very high numbers for the medium term, so the sort of 5% year-over-year rates we see in the US, that will pass. But the question is, with significant inflation impulse that lasts beyond a mere transitory spike, where does inflation settle? And I think it's reasonable to think that we remain well north of about 2.5% in the US, probably north of 2% in Europe. And that is a very different scenario than what central banks are pricing in. And with it will require a material adjustment, both in the forward guidance initially and then in the policy outlook. So probably within the next few months, the Fed might be the first big bank. The Bank of England has already gone. Central banks start to sound a bit less ultra dovish and just dovish. And let's see what the market does with that. I think it's going to be a pretty rocky road for a while.
Yes, so let me ask you a bit more about that. You're thinking then on policy decisions made by central banks. Broadly speaking, Callum, do you have reservations about the messaging we're getting or the policy decisions they're making at this point?
Across the board, central banks are likely to tighten policy, or to put it a better way, normalize policy faster than they currently signal. So in the UK, I think we should be expecting rate hikes as soon as Q3 next year. I think there's a chance they surprise us and end QE in August already. I think the Fed will start its tapering in early next year to make way for a rate hike late next year. The ECB will even start to sound quite hawkish next year. That's a good 12 months probably ahead of what central banks are currently signaling. And what we expect essentially as the catalyst for this is once this very peak inflation pressure passes, sort of towards the start of next year, it will become obvious by then that fundamentals will keep inflation above central bank targets. And that then will prompt this adjustment by central banks to force them to normalize a bit faster than they currently signal.
Okay, so we'll get through that initial push in inflation, but then the fundamentals will mean that inflation is sticking with us, in your view, Callum. What kind of threat do you think the Delta variant poses, and how much of a focus should it be as we go into the Fed meeting? We've seen the CDC changing mask mandates, of course, in the United States, and we see certain pockets of the US very under-vaccinated compared to the average. What kind of weight are you attaching to concerns around the Delta variant?
Well, virus risks, of course, are the primary concern for the global economic outlook. That remains the case. It's been the case for a good 18 months now. But we can take some sort of tentative optimism out of what we see in the UK, which seems to be the global test case for what happens when an advanced economy with a high rate of vaccination allows a wave to sort of run its course without significant restrictions. There's a little optimism in the UK data that recorded positive tests are now starting to fall sharply. But more than that, what we see are two things. First, a big difference this time around between infections and complications and deaths. Both of those are much lower. And second, what we see is a decoupling in the UK of virus trends from economic trends. The virus has spiked. We've seen this wave, but we haven't seen a material deterioration in economic trends. So that caution factor has not been very significant. I think for other advanced economies, the US, Europe, which are probably a few, say 4 or 5 weeks behind the UK in terms of this Delta wave, I think they'll look to the UK as an example of what happens once you've got high vaccinations and you just try and ride it out.
Yeah, absolutely. So we'll continue to focus on the hospitalisation rate here in the UK, a crucial piece of the data puzzle for the UK and for other nations as well. Callum, thanks very much. Stay with us. Callum Pickering, Berenberg Senior Economist. Just a quick mention of some of the banks and how they are trading this morning, because we had earnings out, of course, from the likes of Barclays, Deutsche Bank and Santander. So let's just go through a few of those. Santander moving to the downside, actually, even though they gave us some fairly positive commentary in the interview that we did with the CFO a little bit earlier on. But that bank moving to the downside. They say they're on track to outperform their 2021 profitability targets. Let's have a look at Deutsche Bank and Barclays, both moving to the upside. The story at Deutsche Bank, some positive narrative coming through from our CFO conversation there, James von Moltke, talking about 2022 revenues, and particularly the FIC business delivering well beyond what we'd seen from rivals over on Wall Street. Barclays also performing well, shares advancing as results really beating expectations. Some of the most recent commentary coming out of the business today, talking about cost controls at the Barclays investment banking business remaining very good, which of course is a focus as we think about banker pay and all of the headlines that we have covered on that front in recent months. Coming up on this program, it's been a big day for earnings, just been through a few of them, and it continues this hour. We're going to be speaking to the CEOs of Man Group and Capgemini. This is Bloomberg.
debate happening in the business world right now is how to get workers back to work and what benefits to give your employees. Microsoft is asking employees to be back in the office 51% of the time, but you're flexible about the rest of the time. Is that a permanent policy? And for those companies that are saying you have to be back in the office 100% of the time, are they on the wrong side of history?
I think we at Microsoft, we want to be much more data-driven. I also think that in time, if a year from now, we will have more sense of what the real structural change and needs and the expectations of both our employees and our customers are. And we'll really think about long-term policies based on, quite frankly, having all of that data behind us, because otherwise I think we're trying to come up and being too overly dogmatic when I think we need to be more experimental in our approach to return to work, because I do fundamentally believe the world's changed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What's happening is a good thing, because what the Chinese government is now doing is cracking down on the big companies that dominate various sectors at the exclusion of smaller companies.
I love issues. The more issues they are, the better it is for us.
There's always this kind of political risk or tail risk.
It's certainly causing some, around the globe to question some of their exposures.
Foreign investors will have to have a clearer view of sectors which are investable and sectors which are not.
Investors who perhaps have got a little bit more of nervousness to them may want to sort of sit on their hands over what is normally a quiet summer period.
And for someone like us that's got long-term capital, we can end up doing exceptionally well out there.
There's no way that any global investor can ignore China.
I don't know what the Chinese government is going to do next, and so you have to be wary.
Guests on Bloomberg TV weighing in on China's policy moves and investment outlook. We will pick up on that conversation in just a moment, but I just want to bring you some headlines coming through this morning in connection with Credit Suisse. Credit Suisse's Archegos inquiry finds faults the bank's due diligence. The review finds Credit Suisse face huge exposure for low revenue. The lender is set to release the results of its internal inquiry on Thursday. That is tomorrow. We'll get results broadly from the bank tomorrow, and so it looks as if we will also get the full details of this inquiry. But this is the inquiry into the collapse of the family office Archegos, and the inquiry will show or will fault the bank's due diligence, we understand. We'll look for more details. The lender is so the review finds the bank faced huge exposure for very little revenue. The internal inquiry into how it lost about $5.5 billion on the collapse of Archegos. It's going to paint a picture, according to my colleagues, of severe failures in due diligence as employees chase business that made little economic sense. This, according to people briefed on the findings. More detail on the collapse of Archegos, the collapse of Bill Huang's family office, and the impact on Credit Suisse. More about that tomorrow as we cover the earnings story coming out of Credit Suisse. Now, we started this part of the program with a summation of some of the commentary we've had about the China crackdown from some of our guests. Let's get an economist perspective. Callum Pickering, Berenberg senior economist, is still with us. Now, Callum, when we look at what China is doing and clamping down on the ability of businesses to make profits in certain sectors, it's either niche or wide-ranging, depending on which view you take here. And some economists are suggesting this is going to have an impact on the underlying profitability, or sorry, the underlying growth of the Chinese economy, and others saying, no, this is still quite marginal, actually. Where does your concern around China lie?
Well, the specter of regulatory uncertainty can be very damaging to economic performance. It can affect risk appetite. It can affect the proclivity to invest. And this is potentially a big challenge for China at a time when its underlying growth momentum is declining as it becomes more advanced, and it needs to rely more on domestic-oriented services to provide the main engine of growth. So this is a potential issue. The one thing I would just highlight here is probably what the leadership in China takes with one hand, it will give with the other. So if we were to see a significant and pronounced slowdown in Chinese economic momentum, I would expect some stimulus measures to come in pretty fast just to stabilize growth. So over the long run, it's a challenge for markets. Investors are right to highlight some of these issues as potential reasons to not invest in some big Chinese companies. But from a markets and a macro point of view, I actually don't think this is a big issue. I think probably what we would see again is just this stimulus effort if it started to have a major deteriorative effect on Chinese economic momentum.
Right, and so maybe we are right to rest on those reassurances we get from Chinese media that flag the economy is still in a strong position, monetary policy is still supportive. What kind of growth expectations do you have then for China, given the headwinds perhaps coming from this kind of clampdown, but the more stimulative effects of fiscal and monetary policy?
Well, China is already above its pre-pandemic level of economic output. It's now, depending on what measure you use, the biggest economy in the world. So what we don't need is 8% year-over-year growth like we enjoyed a decade, 15 years ago, in order for China to contribute a lot to global demand. So anything in that 5 to 6% range, which is probably sustainable for a few years, will be sufficient. And the key driver of the global economic story over the next few years will be the Western consumer. That is European consumers, US consumers that have strong balance sheets, a huge amount of excess savings that are just eager to go out and spend after 18 months of restrictions. So the market narrative that you have to look at China, take the credit impulse and decide where global industrial output is heading, that may have worked for the decade after the financial crisis when we had to go through a painful period of balance sheet repair in the West. But that narrative no longer applies. We should look to the Western world as the main driver of economic growth. And all we need in that respect is for China just to remain stable for a few years. And I think that's probably a safe bet.
That's really interesting. Thanks for your perspective, Callum. Callum Pickering, Berenberg senior economist, joining us there, talking earlier about the Fed and there about China. We will be continuing our conversation with Callum Pickering on Bloomberg Radio. That's at 9 a.m. UK time. Let's take a look at some of your movers 17 minutes into Wednesday's trading session. And we have a host of corporates reporting. Some of them are reflected in this selection of big moves today. So Moncler, the fashion house, down by 4.3% in this morning's trading session. Their first half numbers, revenue beating estimates, described as solid by Morgan Stanley, but it seems that the stock is moving to the downside. Let's get to Wizz Air. This is a stock that is moving higher this morning. We see the Wizz Air share price up by more than 4%. We spoke earlier on to the CEO, Joseph Ferradi, about leisure traffic. It's already back. He said the world will be moving on from coronavirus, even though obviously they are very much at the mercy of a lot of governments globally or around Europe and are not able to give much of a clear outlook for the next quarter. And let's get to Capgemini, because this business over in Paris, over in France, is in focus. IT services business, consulting business. We're going to be speaking to the management of Capgemini a little bit later on, and you can see that the share price is up by 3.8%, gaining on the higher operating margin forecast that we've had through from that business this morning. So 20 or so minutes, just coming up to 20 or so minutes into our trading session. And we'll take a look at the tech sector. Apple shares slide in extended trade after the company warns sales growth may slow following its record quarter. More on tech next. This is Bloomberg.
anos sem se apresentar, as escolas estão começando a reabrir, os teatros não vão reabrir tão cedo. Aí a gente teve a ideia, no melhor estilo do Milton Nascimento, vamos levar a música aonde o povo está.
A minha missão hoje é fazer as pessoas sorrirem, cara. Sorrirem, olharem da janela, verem uma coisa inusitada, ficarem felizes, mandarem pros amigos e, enfim, curtirem um momento diferente, mesmo dentro de casa.
Billionaires in space?
What defines going to space?
There is a level where you
It's
get
the common line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing that I mentioned and you carried on talking and ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It really was a blowout quarter for Apple, a record $81 billion of revenue in the third quarter, and the iPhone accounting for half of it. There's real evidence that Apple is seeing foot traffic through its retail locations globally as different economies reopen and recover from the pandemic, but also evidence that the 5G supercycle rolls on. 5G is driving handset adoption, not just in developed markets like the United States, but it's going down well in China too, and in emerging markets like India. And here's what Tim Cook had to say about the ongoing prospects for what 5G could do for Apple.
We're only in the early innings of 5G, but already its incredible performance and speed have made a significant impact on how people can get the most out of our technology.
Services did well in the quarter as well. The problem is Apple expects that level of growth to slow down going into the fiscal fourth quarter. Yes, they do expect double-digit growth, but particularly in services for that to slow down. At the same time, Apple is contending with the same supply chain challenges that everyone else is. Tim Cook was talking about how they're not happy with what they're paying for freight, for example. They're struggling in some areas to bring certain parts into factories, which could inhibit their ability to produce certain products. And just like everyone else, Apple is contending with a global ongoing shortage of semiconductors, one that does cloud the vision for the future, the outlook for the future somewhat. But remember, of course, Apple likes to bring new products to market in those later stages of the calendar year. So come September, October, we could see new products that help drive Apple forward. Ed Ludlow, Bloomberg News, San Francisco.
We'll be back to the product launches shortly then. Ed Ludlow with that update there on Apple and the earnings, that report from San Francisco. Let's get a Bloomberg Business Flash here in London. Here's Laura.
Thanks, Anna. Spain's biggest bank says it's on track to beat a key profitability metric for the year. Earnings from the US and UK are fueling Santander's resurgence after historic losses linked to the pandemic. Net income came in at 2.1 billion euros in the second quarter, topping analyst estimates as Santander's US consumer lending business helped power its recovery. Microsoft has reported sales and profit that exceeded analyst estimates for a 10th straight quarter. Cloud computing business Azure saw sales increase 51%. And in another tech beat, second quarter sales at Google's parent company Alphabet surged past the street's estimates, with ad sales growing to homebound users spending more time on screens, as well as consumers venturing out to shop and travel. Rio Tinto plans to spend $2.4 billion building a lithium mine in Serbia as more big miners push into metals tied to green energy. The move comes as Rio reported first half underlying profit of $12.17 billion, below estimates for a $12.6 billion. The mine will be one of the largest industrial investments in Serbia, contributing 1% directly and 4% indirectly to GDP. US President Joe Biden is reported to be planning to require all federal employees to be vaccinated against the coronavirus or submit to regular testing and mitigation requirements. CNN says the announcement could come later today. US health officials, meanwhile, are recommending fully vaccinated people should go back to wearing masks in some indoor settings. The reversal by the CDC comes as the Delta variant continues its spread. That's the Bloomberg Business Flash. Anna.
Thanks very much. Laura Wright here in London with your Business Flash. Let's just quickly check on some of the share prices of the banks that have been reporting today. Santander moving to the downside, despite, not by much, I should say, by 1/8%, despite some strong headlines that they're on track to outperform their 2021 profitability targets. They're going to beat that goal. They're seeing much better than expected credit cycle, very comfortable with the capital position. That was the message from the CFO earlier on, but the stock moving lower. Deutsche Bank and Barclays, though, by contrast, moved to the upside. And we've got a move higher in the Deutsche Bank share price, up by 3.9%, and we had a long conversation with the CFO a little bit earlier on. The bond market, the FIC trading environment is normalizing, but had been playing to their strengths, of course. So they managed to get increasing revenue from various parts of the business, so had to, as a result, manage to upgrade their revenue guidance for 2022. The provisioning looking better, and we also got numbers out from Barclays, and there's a share buyback in the mix there as well. That stock up by 4.8%. Coming up on this program, we'll stick with the earnings story out of the financial services sector. We'll head to the hedge fund world. Man Group assets swell to a record in the second quarter, but net inflows are under what had been estimated. We will talk to the business, though. We'll talk to Luke Ellis, the CEO of Man Group. Maybe the estimates were off. They did manage to drive $6 billion worth of performance gains, so that is what was taking the overall funds under management to a record. That conversation next with Luke Ellis. This is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance, and more.
2022年完成空间站的在轨建造，建成国家太空实验室。之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station. China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got
all
more
over.
time here. Have you
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. Half an hour into our European trading session, and you can see European equity markets making modest gains. There's a lot going on today. We've got corporate earnings coming through fast and furious today and tomorrow. I should flag also a lot of corporate earnings coming through, but the Stocks Europe 600 up by 0.2%, a little flatter in the London market. Let's have a look at where we are on the sector perspective. You can see it's a sort of mixed bag, but the bias to the upside, I guess you'd say. We've got basic resources, chemicals and telecoms, the only sectors moving lower. Elsewhere, we are to the upside, and the best performing sector, travel and leisure. We saw analysts at Barclays actually upgrading some of the operators in that sector a little bit earlier on, and we've had slightly better mood music when it comes to regulatory controls. Perhaps in Britain, that may be having a little bit of an impact on what we see on that particular sector. Let's get on to one specific earnings story this morning from the hedge fund sector. Man Group earnings are out this morning, and funds have swelled to a record in the second quarter at the world's biggest publicly traded hedge fund. That news comes as net inflows for the first half came in below what analysts had anticipated. Maybe they'd anticipated the wrong number. Let's talk to Luke Ellis, who's the CEO over at Man Group, and he joins us now on set here in London. Really good to speak to you then, Luke. So let me ask you firstly about what's been going so right in terms of funds under management at a record level, performance gains of $6 billion. What is it that's going so well? What strategies are really driving that performance?
I think that's the point in the earnings result is, you know, what we've done is deliver really good performance for the clients, and that generates very good performance fees. And so we've sort of blown through consensus estimates for earnings. And I think that the sort of earnings per share are up 250% nigh on. So, you know, we think it was a pretty good thing, and it was about performance. And there was a lot of different things that made money in the first half, but particularly the quant macro stuff was very good for us and enabled us to make good returns. You know, one of the interesting things we've seen in the last few weeks is, you know, sort of all of the discretionary managers think that bonds must go down. And everybody's been talking about we're going to see higher yields this year. And, you know, the models had recognized that something different was going on in bonds, and that was a good source of profit. Commodity markets, you know, sort of most hedge fund managers, most fund managers forget about commodity markets. They're a bit sort of messy and whatever, but actually they've been very good for us in the last 6 months.
Okay, so you've got the bond markets right, and commodities are helpful. In terms of inflows then, so is the performance gains making up for perhaps a little bit lackluster number on inflows compared to estimates, or was the market just expecting something too big?
We run an institutional business, and so our inflows are lumpy, and we've always sort of said they're lumpy. At the end of the first quarter, I made a comment about the fact that, you know, we were sort of confident in the amount of client engagement we got going on, and that we saw over the coming quarters very good flow momentum. I stand by what I said. I didn't say over the coming 3 weeks. I said over the coming quarters. You know, there was a couple of things which could have happened in the last quarter, slipped just because of legal things that are happening now. But, you know, we're very confident in what we're delivering. The clients like the performance. The best way you grow assets under management is generating outperformance, because that's the highest quality sort of asset growth you can get.
Okay, what can you tell us about the sustainability then of this performance into the second half? It's too early, perhaps in some levels, maybe too early to call the bond markets. But how do you assess it already?
Yeah, look, I think one of the bits is the performance fees that we showed in today. Those are the performance fees which crystallized in the first half of the year. We have a number of strategies which have crystallization June to June, but we have more strategies that are December to December crystallization. And the first half of this year has been good in performance terms, both absolute and outperformance of our strategies relative to peers. If that stayed the same, we'd have a very good second half. If we have a good performance in the second half, we'll have a great second half. Of course, markets might change completely and we'll end up with some other outcome. But, you know, I think we're all going to see what happens in markets come September. You know, we're in a slightly false period at the moment, and when liquidity comes back, it'll be interesting to see the next moves.
How would you assess the hedge fund industry at this point? Some suggesting it's come out of a fairly tricky time, tricky to attract funds in some cases. Although your story will be the story you'll stick to. But how do you assess the sector as a whole? Is it making a better case for itself at the right price at this point?
Yeah, I think, look, actually most of the big hedge funds, most of the people that have been growing, have been delivering very good performance. We have, but so is a number of the peers. It is definitely the hedge fund business is getting more about the large getting larger and generating more performance, being able to hire the best people, thereby generating better performance, thereby getting larger. So when you look at the performance of the largest, say, 20 or 50 hedge funds, the performance has been pretty good over a number of years, and the inflows have been pretty good. This is another quarter of positive inflows for us. I think one of the bits you're seeing at the moment is every client is worried about inflation. When they say they're worried about inflation, what they really mean is, I own a load of bonds, is that going to cause me a problem? And so we have a lot of conversations about what alternatives can you have that generate you a steady return and aren't correlated to equities, because everybody's basically as long equities as they dare be institutionally. And that's where hedge funds offer a really interesting alternative. That's their job, is to be an alternative to bonds, generate a decent return, doesn't have to be knocking the lights out return, but uncorrelated to equities.
And so they're concerned about inflation, preoccupied by inflation maybe from a client perspective. What about the latest movements in the market in China? I don't know what early conversations you've been having with clients about the turbulence we've seen this week. I mean, some markets, the Hang Seng, for example, flirting with the 20% move from its recent highs. Are investors changing priorities, getting nervous about Chinese exposure?
I think there's an awful lot of questions going on about what have they got. We have a very much a valuation focus in the firm when we look at stocks, and that had led us to avoid a bunch of the go-go names in China, which the valuations were extremely high, and those have generally been the thing the Chinese government has been picking on. And so it's really the most overvalued stocks which have had the bad news and had some really big moves down. Those are things we avoid generally, and so we've had a sort of a week watching the carnage without being caught by it, which is a nice place to be. We've had a lot of client questions as to what led us to avoid it. And I think, it's impossible for investors to ignore China. And if you're a global investor, it's impossible to ignore China. It's the second biggest economy in the world. It's the second biggest market in the world. Trying to understand what your allocation should be is one of the most important things a CIO can do. So we have a lot of conversations about it. The interesting thing for us as a sort of active manager, as a hedge fund, the alpha opportunity in China is tremendous. So we had a good first half of alpha in China. We've good month of alpha in this month. There's lots of opportunity because of the fact you get a lot of big movements in names.
One other asset that I wanted to ask you about, which you maybe have had doubts about, is crypto. You certainly have had doubts about it in some of the comments you've expressed recently in the media, but that hasn't stopped you from trading it. I wonder how it's performed for you of late.
Well, we don't pick out individual instruments, but fine would be the answer. Our natural approach is not, there's two approaches to crypto, I guess. There's the one many people have taken, which is to buy it and put the diamond hands emoji on their LinkedIn post or their Twitter thing and say, look, I'm going to hold this forever. That's not our approach to anything, frankly. We like to take it something like Bitcoin for us are just a tradable instrument. There is no fundamental value. Spending a lot of time trying to debate whether the fair value is X or Y. It's just driven by buyers and sellers, and so our models look at when we think there are more buyers and sellers and try and get long, and vice versa when there are sellers. And it's highly volatile. That suits a quantitative process. And so, you know, it's an interesting market for us.
Interesting market. Something very much of interest, just finally, Luke, for our viewers, is any conversation around the way the workplace changes post-pandemic. We're sitting here having a conversation face-to-face, which I have to say makes a change from all of the conversations I have down the barrel of the camera lens normally. Does this tell us anything about the approach at Man Group, about how much people are coming back to the office, about how much you see that as the future?
I think hybrid working is here to stay. And so, you know, I've got today, I can't remember, I think I've got 4 face-to-face meetings and 6 WebEx or Zoom meetings. I think that'll probably be the norm in the future. You know, our guess, it'll be very different by individual, but our guess is probably the average person in the firm will be in 3 days a week. You know, some will be in 5 days a week. Some who do particularly non-regulated things will be, many of them will not come to the office again, and that's okay. You know, I think as a boss, as a manager, as a business, what we need to do is to create the environment where people can be as productive as possible. For me, I like coming to London a couple of days a week. It's nice to see people, humans. I love my wife, but it's nice to see different people as well. You know, it's nice to go out and have a nice meal.
And it helps when it's not raining also. Yeah, London more popular this time of year. Luke, really good to see you. Thanks very much. Thanks for coming in to talk to us. Luke Ellis, the CEO of Man Group. Let's get a Bloomberg First Word News update. For that, here in London, here's Laura.
Thanks, Anna. Fully vaccinated tourists from the EU and the US are set to be allowed to travel to England on the same basis as Britons returning from abroad. Bloomberg understands the policy will be finalised at a meeting of senior UK government ministers later today and could come into force as soon as next week. The House committee investigating the riot at the US Capitol has taken testimony from 4 police officers who fought for their lives against a mob of supporters of then-President Donald Trump. Capitol Police Sergeant Aquilo Gonell likened events of January 6th to something from a medieval battlefield. He described the physical violence police experienced as devastating. Sydney's month-long lockdown has been extended by at least another 4 weeks after daily COVID cases hit a new record of 177 infections. The announcement came as week-long lockdowns were lifted in Adelaide and Australia's second biggest city, Melbourne, which recorded 10 new cases. Around 14% of the population has been fully vaccinated. And 4-time Olympic gold medalist Simone Biles has pulled out of the women's gymnastics team final event, saying, "I have to focus on my mental health." 24-year-old Biles, the world's preeminent gymnast, cited her state of mind and the risk of injury after she faltered on a vault. Sponsor Gap says they stand by her decision and support her well-being. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Thank you very much, Laura Wright, here in London. Coming up on this programme, the French technology and consulting company Capgemini boosts its operating margin forecast for the full year. That off the back of a revenue surge. We speak exclusively to the company's CEO. He'll be with us next to talk about those earnings and prospects for the company ahead. This is Bloomberg.
I've always sort of pictured what it was going to be like. I mean, you know, like the ride up there, the ride back. And I never realized that the whole experience was going to be so vivid.
But beyond sort of the satisfaction of your own goals being achieved, what does today symbolize for the company and also for all those children that were present earlier?
Well, look, for the children, we've just got to get building as many spaceships as we can, as fast as we can, so that one day those kids will have the chance to have a similar experience to what I had. And that we will do. We also launched this giant global raffle today, so that, you know, 2 kids for, you know, just $10 for a pair of tickets. If they could win the raffle, they can go up. But that money will hopefully enable many, many people to be able to go up who could never have dreamt of going to space.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Welcome back to the European Market Open. 45 minutes into our European trading session, making modest gains across European equity markets. A little bit weaker on the DAX, fairly flat on the FTSE 100. The French market performing well, and that is relevant to our next conversation. Capgemini has boosted its operating margin forecast for the full year, beating analyst estimates. The French technology and consulting company also saw revenue during the first half surge to 8.71 billion euros. That was ahead of forecast. Let's speak to the CEO of Capgemini, Ayman Ezzat, who's with us this morning. Ayman, very good to speak to you. So you're guiding a little bit higher when it comes to your full year revenues from 7 to 9%. To 12 to 13%. What gives you that confidence?
Well, basically, we had an excellent first half, which came well ahead of expectation. You know, the demand for technology and the appetite from our clients in terms of technology investment is extremely high and continues to increase since the downturn in Q2 last year. We have seen an uptick in terms of demand across all platforms and across all areas of our clients. Our H1 performance came way ahead of expectations with more than 7% organic growth, and we see that really continuing in the second half of the year, maybe some acceleration. That really gives us the confidence. We really see the demand for technology in front of us. We have seen the signings that we have seen in the first half, which is a pipeline of potential opportunities. The discussion we have with CEOs and our clients, that gives us a lot of confidence, not only, I'd say, in the second half, but in the fact that we see an acceleration, structural acceleration in terms of demand in technology across the board, and that gives us a lot of confidence for this year, but also for the coming years.
And what do you see in terms of customers' appetites for investing in IT spending, Ayman? What is the attitude that your clients have towards investing?
No, so the attitude is extremely positive. They really see that technology is a fundamental driver of the digital transformation. And the interesting thing is not just one pocket. So you can think about the enterprise itself and how we can help the company run its processes and run more efficiently. And here's a lot of digital coming in. But you have to think about the client relationship is more and more digitally enabled. And through that underlying, it's really IT. And now, all what we see in terms of the development of new products, so we take auto manufacturers, they have to launch all the new electric vehicles, and basically 60% of the cost of development of a car now is going to be around software. And that's where we play. Where we play is bringing together the physical world with our engineering capabilities in automotive with basically our capabilities around digital, and the two together. This is how we can address some of the client challenges they have in terms of how do I build my next strategy in terms of vehicles, electric vehicles, and how do I create the autonomous system to be able to support them. And that's where we play, because we can really become the strategic partner of clients to enable them to be able to make that happen.
And what appetite do you see for cloud investments amongst your clients, Ayman? Because there have been some customers who maybe have been hesitant to really fully invest in the cloud in terms of data storage because of the cost involved, because of regulatory restrictions, because of not wanting to give up full control. What do you see on that front?
I think the post-pandemic boom around the technology investment has been driven by cloud. Data is definitely there, but really what we saw is the appetite for cloud across all clients, even some reluctant clients, in some countries in Europe. I think it has completely changed. So every single CEO has today on his agenda, what do I do around cloud and how I move that? And I see CEO is not the CIO, not his chief information officer, it's the CEO himself. So we see basically major cloud movement and migration because that brings to companies the enablement to be able to accelerate the digital transformation. They need to be on a cloud platform to be able to make things happen, to be able to put products on the market in terms of days, in terms of months, to be able to enable the acceleration of the development of the new products and to be able to optimize the cost of operation. So we see that really across the board, and cloud is a fundamental technology platform to enable all of that. There are still mixes, like in France, we launched Bleu because there was some requirement in terms of sovereignty, for example, from the French government, but also from some structural and important companies in France that really want to be completely shielded from any potential interference from any extraterritorial interference. And even that, we have launched, with Orange and on a Microsoft technology, basically a trusted cloud in France, which is basically allows to enable to shield against any extraterritorial interference and respond to the demand that clients have in that area.
Thank you very much. Thanks for joining us. Good to speak to you. The Capgemini CEO, Aiman Ezzat, thanks very much for bringing us the story behind that 4.1% increase in share price that we're seeing on this morning's French market trading. Coming up on this programme, what to expect from the Fed. Let's not forget, in amongst all of this earnings news, we do have the Fed to talk about. And more on that fallout from China. We talked to Man Group's CEO about that and how they've managed to avoid some of the carnage we've seen there. But we'll certainly talk about all of the factors driving this morning's price action. That coming up, that conversation with the Market Live team next. This is Bloomberg.
Wednesday, the Fed decides. How worried are they about inflation? What will they signal about tapering? Coverage begins at 1:30 p.m. Eastern on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. 8:53 here in London. European equity markets just on the front foot. And actually, those markets that were in the red earlier turning a little more positive. We've got some of the airlines moving higher today. An upgrade from Barclays on the sector. Some better mood music when it comes to the transatlantic travel, certainly between the UK and the United States, and also Europe and the UK. Certainly that's in the mix as well for aviation stocks and some earnings from the likes of Wizz Air. Let's get into a markets conversation then now with Laura Cooper, Bloomberg's Markets Live macro strategist, who's with us. And we seem to be flat to positive this morning, Laura. There's a lot going on, a lot of conflicting messages, I suppose, for investors to deal with, whether you look at China or the earnings story.
Well, and we did have quite whipsawed price action overnight, and that is turning into some signs of a tentative turnaround early in the European session. We did have those Asian equities edge out some gains, and that's as we are seeing this Chinese angst ease somewhat, but at the same time, we are still seeing these growth fears, I think, percolate through the markets, but that's being dominated by these upbeat earnings. So the European session really is dominated by those bank earnings that continue to surprise to the upside.
Yeah, and what was it about the bank earnings that stood out to you? I mean, we've got a really positive outlook on 2022 from Deutsche Bank in terms of revenue that they can continue to make, and the fixed side of the business, the fixed income and commodities and currency trading. What's been standing out to you? Because also Barclays higher as well.
Yeah, and it was really that equities trading that stood out in terms of Barclays that is kind of driving that stock price higher today. But I think really the key takeaway for me was around those loan loss provisions. The fact that those are being released, I think, to a greater extent that markets expect, does point to a relatively upbeat outlook in terms of the consumer, in terms of businesses. And so I would expect that banks are going to get further upside from that. Banks are struggling this quarter as that reflation trade eases, but certainly more upside on the back of these upbeat expectations.
Yeah, and the Deutsche Bank provision for credit loss is down by 90% year on year, which, I mean, is testimony to how crazy last year was. Just briefly then, Laura, the Fed, how do you approach the meeting later?
Well, market expectations are for a relatively benign meeting, but I think we are likely tilted more to the risk of a hawkish surprise. And that's because we are seeing these signs of stronger than expected inflation. So that could tilt them towards those potential tapering timeline hints, even though, yes, that kind of threshold for substantial further progress has likely not been met. We are seeing these rising risks around the Delta variant that will see them strike a cautious tone. But as we saw in June, there is just this risk of them coming out because we are seeing price pressures potentially be more persistent than I think is currently baked into their forecast.
Yeah, Laura, thanks very much. We were talking to the Man Group CEO earlier on. He was saying clients just really preoccupied by this question of inflation and bond markets and what their bond market portfolio is going to do. So that's a really interesting part of the conversation right now. Laura Cooper, Bloomberg's Markets Live macro strategist. Thank you very much for joining us. That is it for a very busy European market open. Surveillance early edition is up next and will be no less busy. They'll continue to take you through some of these corporate earnings stories. European equity markets fairly mixed. The banking sector mixed on those earnings. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
The regulatory crackdown is probably, in the long run, going to be good for the Chinese market.
This is one of the biggest factors behind the downgrade, the Delta variant.
We see really bullish signs for performance for 2022.
This is Bloomberg Surveillance, early edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger here in London, and this is what's coming up on today's program. Credit Suisse's internal inquiry into Archegos collapse finds due diligence at fault, with the bank putting billions at risk for very little revenue. Meanwhile, Germany's Deutsche Bank weathers a slump in fixed income trading, lifting its revenue guidance for the next year. We'll hear from our interview with James von Moltke. And a big beat from tech fails to impress Wall Street. Apple sees record third-quarter sales, but slides post-market after warning of slowing growth. It certainly is a strange market when you have the micro of these earnings coming head-to-head with a Fed decision, with growth concerns, with concerns over China as well. We are seeing, though, European equities starting to gain after a flurry of earnings from companies this morning. But even as some banks announce positive numbers, the focus, of course, returns to Credit Suisse after its internal inquiry into the Archegos blow-up finds its due diligence at fault. Bloomberg
of the provisions for the pandemic, we saw earnings top consensus by 16%, Danny.
All right, Julie, you'll have to forgive me. I'm going to ask you to move across industries now, because we also had the tech earnings from Microsoft, Apple, and Alphabet last night. What's the pre-market reaction so far?
I thought you were going to say I had to move the screen, but you can see these. We are seeing Apple shares a little weaker because you mentioned earlier, Danny, that even though we saw this beat, we had this very strong iPhone sales coming through. You do have this caution that rippled through from Apple as it said that the sales growth could be slowing. Supplies are getting tight. We know that particularly very well here in Asia with the supply chain issues. Then you've got Microsoft looking like it is going to go higher. This was a beat as well. Sales and profit exceeding analyst estimates for a 10th straight quarters, but there were a little bit of signs of spookiness from investors, and this is about the cloud computing business, about Azure, because remember, it is still facing some very stiff competition from the likes of Amazon and Google Cloud. Danny.
Juliet, all over the moves for us this morning. Juliet Sally in Singapore, thank you so much. Now, as Juliet was mentioning, as earnings unfold, one of the main areas of concern is, of course, inflation. Both corporations and consumers alike are concerned about price pressures, and while some brush off the rise as temporary, others do indeed think that it's structural.
We clearly see inflation now in the United States in particular.
It is obvious that we have a very, very important spike on inflation.
I'm somewhat on the side of those who think that we may well have an incipient inflation problem.
I don't think that this level of inflation is sort of a precursor for a large inflation boost. But obviously, one needs to watch this very carefully.
There's another part of the inflation that we believe is more structural.
You have to take into account input costs going up. It's a clear area where there are some challenges today. And our instinct is this will persist for some time.
The global supply chain is not working exactly as it should be.
The rise in raw materials is such that we have to act.
So you see a bit of inflation there, but it's transitory, so it should not be a real concern.
More or less all costs have gone up, and yes, we're transferring some of that to our customer.
Right now, we do believe there's a little bit of carryover inflation, but it's too early to say.
We're joined now by Stephen King, HSBC's Senior Economic Advisor. Stephen, thanks so much for joining us this morning. And look, we've gotten a lot of commentary from corporations about the inflation concern. Some data from Bamble said that the amount that inflation was mentioned increased 1,000%. I mean, over and over again, what do you make of that, of the continual citation of higher prices for all of these companies?
Well, obviously, you quoted a whole bunch of people who clearly are very concerned about inflation. Of course, the central banks themselves are generally quite a lot more relaxed. They're saying we can look through all this. But then quite reasonably, I would say, well, central banks, of course, will say that, because if you can't look through it, it would mean they were making a series of policy errors, which they don't really want to admit to. The reality is that we're facing tremendous uncertainty with regard to inflation, that some of it, doubtless, is associated with the sort of immediate unlocking pressures associated with the pandemic. These are sort of temporary increases in costs because container ships are in the wrong place and workers are in the wrong place. But there are other things going on which are possibly more worrisome, one of which is the fact that money supply growth was incredibly strong in the US last year. Another is that you've got a whole bunch of pent-up demand for consumer items because people have been forced into saving during lockdown. And of course, you've got a massive fiscal stimulus coming through from Biden's administration. So there are a bunch of things out there that if I were a central banker, I'd be feeling just a little bit nervous about at the moment. And also beginning to think that perhaps the trade-off between growth and inflation possibly is deteriorating. In other words, at any given growth rate, inflation is danger of being higher now than it used to be in the past.
And don't you worry, Stephen, we will definitely dig into the Fed and their decision later today a lot. But if I can just linger on some of what we're hearing from these companies, you mentioned consumers high, not as much loan growth. We've definitely seen deposits be very high of them. We've heard this over and over from the banking sector. What does that tell you about the consumer's willingness to go out and spend, and when we might finally see all of this money finally finish getting put to work in this economy?
Well, this is one of the great uncertainties because we've never really had the experience of living through a pandemic and coming through the other side and knowing precisely how people will behave. What we do know, though, is that the places that shut down completely, like restaurants and hospitality, have reopened. And we also know that the ability to hire people to staff those restaurants and hotels and so on has really gone down quite a long way, which is why wage pressures have picked up quite a long way. So there's a bunch of things out there that would suggest that even if there's not a volume of consumption coming through, there are certainly price pressures and wage pressures beginning to emerge.
Right. Well, Stephen, in just a little bit, I am going to ask you to look into your Fed crystal ball, so you're going to stick around with us. That's Stephen King from HSBC. Now, coming up, any tiny change of language could be crucial for traders as the Fed concludes its two-day meeting today. How will it respond to the rising wave of the Delta variant in the U.S.? We'll dig into that next. This is Bloomberg.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
Went up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
It does look like the Fed is going to start to, talk a little bit about how they plan to taper and when they plan to taper. At the moment, we expect that FOMC language will be fairly balanced.
We think they'll probably stay cool for now, but as we look towards the Jackson Hole meeting, we think they're going to have enough data both on the inflation, the labor market side.
And I think the market's priced fairly appropriately here for an end of the year taper. I don't think the Fed needs to push back against it.
The Fed's making things difficult for us, but I've sort of learned
don't fight the Fed. It's a losing battle.
The Federal Reserve will consider adjustments to the policy statement at today's FOMC meeting, notably on inflation language and virus risks. But even as the Delta variant threatens President Biden's so-called summer of joy, Bloomberg Economics does not expect a new COVID wave to dramatically alter the economy's trajectory. Stephen King from HSBC is still with us. So, Stephen, it does feel like expectations are stacking up that we'll still have a dovish Fed, not maybe too much of a change. But what are the key points that you'll be looking for when we hear from Chairman Jay Powell today?
Well, I don't think the language is going to change hugely, and we heard plenty from a couple of weeks back. So I think the talk is going to be partly about how much of an inflation risk is out there, how much of it is transitory, are they becoming more worried about something being a sort of permanent shift upwards in inflation. I'm sure we'll hear a bit about the downward surprises in economic data over the last few weeks. They haven't been quite as robust as they were earlier in the year, and doubtless there will be a link to what's happening with the Delta variant, and maybe something more in terms of the timing of tapering. And we know they're talking about this quite seriously today and yesterday, and that's going to be the first thing to move, I suspect. But HSBC's view is that they won't actually start tapering until probably December.
Right. You know, I wonder on that. There does seem to be this growing argument that by maintaining a dovish posture, by saying, okay, we're discussing tapering, but not really giving more to the market, that the Fed potentially risks a taper tantrum, that they're increasing the odds of it. This is an argument that Matt Maley at Miller Tabak makes. What's your assessment on that?
Well, the problem in one sense is that the Fed is dealing with fundamental uncertainty like the rest of us are. And I think central bankers, when they're faced with tremendous uncertainty, prefer, ideally, to do nothing rather than something, because the risks of doing something and then getting it completely in the wrong direction are quite high. And for example, the European Central Bank raised rates back in 2008, which I think subsequently it now regrets. So there are significant dangers of getting it wrong rather than right when you're dealing with a lot of uncertainty.
Yeah, no, that's a very good point to kind of err on that side of caution. I wonder at this point, given the Fed's continual intervention in these markets, you look at a U.S. 10-year real rate at negative 114 basis points. Does that reflect the economic reality of the U.S. and the global market right now, or is that more just about what the Fed is doing?
I think we're really careful about trying to interpret real rates and how they relate to the economy. If you look over a very long period of time, decades, possibly even a half a century, the relationship is really not that strong. And I suspect that part of this is investors not being sure themselves as to what to do. So they buy bonds as an insurance policy against the possibility, however remote, that things go really horribly wrong. So yields are low for that reason, not because there are prospects of a deep recession coming through anytime soon.
Right, maybe not a deep recession, but that rate of change of growth has been really focused on lately, this idea of perhaps peak growth. We recently had Goldman Sachs reduce their U.S. GDP forecast by about 1 percentage point. A lot of that having to do with the Delta variant and the services sector not picking up, that reopening perhaps not as robust in the U.S. Could you see that rate of growth also come down as we consider the fears of the Delta variant?
If I'm honest with you, I think quite a few houses have been cutting their forecasts because they were slow to cut them previously. And what I mean by that is that the trend rate of growth for the US and for Europe has been significantly lower, particularly since the global financial crisis, than people have thought previously. And there have been too many economists out there who've been saying, don't worry, we'll go back to normal. And they've recently discovered that normal is not quite as robust as they once thought it was.
Yeah, I mean, look, we've certainly seen the Citi Economic Surprise Index. Economists, many of them have gotten it wrong, that the data is surprising to the downside. I mean, what do you make of a lot of your peers out there in the world not really getting that economic call? Is it just a very difficult environment to deal with right now when it comes to the data releases?
I'm going to be cheeky here, actually. I wrote a book back in 2013 called When the Money Runs Out, The End of Western Affluence. And they argued in the book that actually trend rates of growth were now much lower than they used to be. I'm afraid to say that too many of my peers didn't read my book. But the truth is that the drivers of growth, 30, 40 years ago, just not there anymore. So for all the sort of gains in technology that we're witnessing, we're not seeing the same kind of gains coming through in terms of productivity. and therefore underlying growth rates are much lower than they used to be. You can blame this on demographics, you can blame it on new waves of protectionism, whatever you want to blame it on. But the reality is that for a long time now, growth rates have been lower than they used to be.
Stephen, we love a little bit of cheekiness on a Wednesday. Thanks so much for joining us. Great to get your insight today. That's Stephen King, Senior Economic Advisor at HSBC. Now, coming up, we turn to Germany, and after its largest lender raises its revenue target for next year, we'll bring you our interview with Deutsche Bank CFO James von Moltke. That's next. This is Bloomberg.
All this money in space, this time in space. Talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Credit Suisse's internal inquiry into the Archegos scandal paints a picture of severe due diligence failures. Bloomberg sources say that the review has found that the bank faced huge exposure for very little revenue. The Swiss lender lost about $5.5 billion on the collapse of Bill Hwang's family office. Credit Suisse is set to release the results of the investigation tomorrow alongside its earnings. Now, speaking of bank earnings, Deutsche Bank out with results this morning. Germany's largest lender is raising its revenue target for next year after beating expectations on fixed income trading. We spoke with the bank CFO, James von Moltke.
We have a portfolio of strong businesses in FIC, and while we did see the normalization of activity in product areas like rates and FX in particular, our relatively strong credit businesses, both flow trading, distressed trading particularly, performed very well in the quarter, and you see that coming through then in our relative revenue performance.
And so what does that tell us about the path ahead from here then, James? I mean, trading has been slowing in some areas, but you point out various parts of that strong performance that you reported. So what can you tell us about that normalization and the path ahead?
Well, we and the others in the industry have been calling for a normalization. We have been seeing that now successively over several months. Because there is a portfolio of strong businesses, we have rates, credit, FX, emerging markets. What we tend to see is weaker performance in one area is offset then in other market conditions by stronger performance in a different area. So we feel very comfortable, to your question, Anna, about the forward, because the market environment that we see going into the second half of this year and into next year is one that we think is still constructive for the businesses. And we see a high degree of client engagement around our offering, our capabilities.
And you've upgraded your revenue guidance, I think, for 2022. Can I get a bit more detail from you, James, on what's driving that? What gives you that confidence?
Well, look, we've implicitly updated our revenue guidance for 2022 because the numbers that we shared with investors in December for each of the core business units, they're either running in line with or ahead of. That gives us real confidence going into next year. We also see much less of a headwind, even in today's interest rate curve, relative to what we had planned on as far back as November, December. So we see really bullish signs for performance above the 24.4 billion that we called for 2022 when we shared those numbers with investors in December.
What kind of pressure you're seeing on wages at the moment? We recently reported that you boosted junior banker pay. What are you having to do in that area to keep up with the competition?
Well, look, we operate around the world in a number of businesses and a number of markets, and in each of those markets, there's a labor market. We obviously aim to hire the best talent. To do so, we have to pay competitively. And as you say, in certain areas, there have been adjustments necessary. In some senses, in some markets, a catch-up after some years of relatively stagnant pay. And in other areas, there are different dynamics, but we certainly see some inflation of our labor costs, as you point out, in parts of the business.
James von Moltke there, the CFO of Deutsche Bank, speaking to us just a little bit earlier. Let's get now to the first word news. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Fully vaccinated tourists from the EU and US are set to be allowed to travel to England on the same basis as Britons returning from abroad. Bloomberg understands the policy will be finalised at a meeting of senior UK government ministers later today and could come into force as soon as next week. Now, Sydney's month-long lockdown has been extended by at least another 4 weeks after daily COVID cases hit a new record of 177 infections. The announcement came as week-long lockdowns were lifted in Adelaide and Australia's second biggest city, Melbourne, which recorded 10 new cases. Around 14% of the population has been fully vaccinated. And former four-time Olympic gold medalist Simone Biles has pulled out of the women's gymnastics team final, saying, "I have to focus on my mental health." 24-year-old Biles, the world's preeminent gymnast, cited her state of mind and the risk of injury after she faltered on a vault. Sponsor Gap says they stand by her decision and do support her well-being. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. And Simone Biles, always the GOAT, whether she competes in this Olympics or not. Now, coming up, time for an aperitif. We'll get an exclusive talk to the CEO of Campari about pandemic restrictions and the outlook for the spirits industry as this market digests the plethora of earnings that we are getting. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Credit Suisse's internal inquiry into the Archegos collapse finds due diligence at fault, with the bank putting billions at risk for very little revenue. Meanwhile, Germany's Deutsche Bank weathers a slump in fixed income trading, lifting its revenue guidance for next year. We'll hear from our interview with James von Moltke. And a beat for big tech fails to impress Wall Street. Apple sees record third-quarter sales, but slides post-market after warning of slowing growth. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, a lot of cross currents to go through, and certainly one of them is the rising cases of Delta, not just here in Europe, but in the U.S. as well. And in a blow to the U.S., President Joe Biden's promised summer of joy, the country now faces a surge in cases fueled by vaccine holdouts and, as I said, the highly transmissible Delta variant. This has prompted health officials to reintroduce tighter guidelines for use of masks. CDC Director Rochelle Walensky told Bloomberg that recent data suggests that some vaccinated people infected with the Delta variant can transmit the virus to others.
Information on the Delta variant from several states and other countries indicates that in rare occasions, some vaccinated people infected with the Delta variant after vaccination may be contagious and spread the virus to others.
For more, we're joined by Bloomberg Intelligence's Sam Fazeli. So, Sam, has the spread of the Delta variant very vastly changed the calculus when it comes to U.S. policy?
Good morning. Yes, it does. Everywhere, I would say. And I think I'm going to take an image used by Eric Topol to explain how this might be best visualized. Assume your vaccine is an umbrella and it's raining hard, and it starts to rain even harder. In order to avoid getting wet, you need to wear a raincoat. So it's as simple as that. You have a much more transmissible virus with higher amounts of virus in your exhaled breath. And of course, that means that if you are vaccinated and you catch the virus, you have an increased risk of also passing it on.
I see. Sam, thanks so much for giving us the latest on this. That's Bloomberg Intelligence's Sam Fazeli. Thanks again for joining us. Now, switching gears a little bit, the Italian beverage company Campari reported sales for the first half that beat average analyst estimates. The Aperol maker saw revenue of €1 billion as pubs and bars reopened across Europe. Now, despite uncertainty linked to the spread of the Delta variant and the possible reintroduction of new restrictive measures, Campari remains confident on the outlook. We're joined now by Campari Group CEO Bob Kunze-Consewitz. Bob, thanks so much for joining us. And last time you joined our program with Francine on May, you coined a term that I just loved. You had previously called this revenge conviviality. So what is the current state of revenge conviviality and how long can it last?
Well, indeed, we had a significant beat versus the market. I mean, the two words I remember from yesterday's analyst call were remarkable and incredible. And that is really due to revenge conviviality, because what we're seeing is that people post, lockdowns, they want to live. They want to entertain at home. They want to have great cocktails at home. And at the same time, they're going out very often or more often than before, and again, having cocktails. I mean, the spirits industry is sourcing market share from both wine and beer, so we have very good foundations. And within that context, our portfolio of brands are really outperforming. I mean, if you look at it, all of our cluster of brands have grown double digit, not only versus a year ago, but more importantly, versus 2 years ago. So cleaned up of any effects of the pandemic. And that really shows the strength, the underlying strength of our brands.
Yeah, I was going to say, you talk to any of the pros, it's that 2-year growth that people care about, considering the comps last year have been somewhat easy. But, when I think about Aperol, for example, you think of a warm summer day, you're sitting outside somewhere drinking an Aperol Spritz. I mean, how dependent is that on the economy staying open and that we don't have Delta or other variants forcing people to stay at home yet again?
Well, what we saw last year, for instance, on Aperol is that Aperol grew. That's because we were able to have higher frequency amongst our existing consumers at home. Clearly, during lockdowns, we're not able to go into the on-premise, activate the brand, and recruit new consumers into the franchise. Having said this, we hope that with the growing rate of vaccination and green passes, that the on-premise will remain open and that we'll be able to continue recruiting new consumers into the franchise. But overall, though, the underlying fundamentals of the brand are very, very solid. And today, in many markets, it's much more than a spring-summer brand. People drink it all year round, and they don't only drink it as an aperitif, they also drink it with meals at lunch as well as at dinner.
Interesting. Have to get a almost like a wine tasting of what to pair Aperol with. Bob, what about extending franchises? Are you looking at any possible M&A targets?
M&A will always play a role in the development of the Campari Group. We've done something like 30 deals in the 20 years that we're a public company, and that has helped, to a certain part, also boost our TSR. I mean, as you know, we've been, since 2001, delivering a TSR of 16% on an annual basis, and half of that growth, on average, has come from acquisitions. We have quite a flexible capital structure now since last year, so we're able to consider all sorts of deals, from small add-ons to really large transformational deals. Ours remains a very fragmented industry, so we're here for the long term, and we'll wait for our turn.
Speaking of large transformational deals, I know you have a JV with LVMH and Moet Hennessy. What's your current relationship like with LVMH, and what do you make of sort of the rumor mill speculating of a potential buy of Campari by LVMH?
That's an interesting one. I think our majority shareholders, the Garavaglia family, are in here for the long run, and the move which we made last year to relocate our legal seat to the Netherlands is definitely to enable us to have more flexibility in the capital structure, enable the family to remain in control of the company, but actually really live significant sums. We're much more in the frame of mind of consolidating as opposed to being consolidated. Having said that, we have a lot of respect for Hennessy. They're a great company. They have a great portfolio of brands. It's very complementary to ours. And we've decided to join our efforts in wine and spirits e-commerce in Europe. It's only focused on Europe. And anything outside of that joint venture, we're competitors.
Right. Very diplomatic of you, Bob. Another thing that has come up over and over again across industries from executives has been inflationary pressure. Quickly here, Bob, what has inflation and pricing pressure looked like at Campari?
Well, the biggest inflationary pressure we've seen in the past 3 to 4 years has been in the price of agave, which is the raw material which goes into the distillation for the production of tequila. I mean, the prices went from 5 pesos to about 30 pesos in about 6 years. And the industry is still, dealing with that, although the price has stabilized. Looking forward to next year, we're seeing inflationary pressures on inputs, dry goods, particularly packaging materials, as well as sugar and alcohol. Having said that, we estimate that will be about 3% increase on our cost of goods, so roughly 1.2% overall company, and we'll be able to compensate that via pricing.
Right. Bob, unfortunately, we're out of time. I also am told that I should wish you a happy 20-year anniversary of listing publicly. That's Bob Kunze-Concewitz, CEO of Campari Group. Thanks again for joining us. Now, coming up, we look at wealth management, and the Queen's Bank joins the rank of ethical brands. Coutts has secured B Corp status. We discuss what that is. Up next, we speak to its CEO, Peter Flavel. And if you have any questions for him, IB plus TV Go on your terminal. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now let's talk about mixing purpose and profit. B corporations are for-profit companies that meet the highest standards of verified social and environmental performance. Now they are legally required to consider the impact of their decisions on stakeholders. In a way, B Corps are what companies to what fair trade is to food companies, rather. There are more than 4,000 certified B corporations around the world, and our guest this morning is from a company which has just achieved such status. In fact, the first private bank and wealth manager to do so. We are joined by the CEO of Coutts & Co., Peter Flavel. Peter, great to have you on. Congratulations about the B Corp. So what exactly does that mean for Coutts and the way that you do business?
Well, Danny, the process around wanting to become a B Corp started off by us looking at our environmental and social and governance activities and asking ourselves, how do we hold ourselves to account and how do we measure that progress? And we knew about B Corp and we knew about the verification process that we had, but the more we got into it, the more that we realised that actually the heart of this is all about redefining what success means for you as a business across the way that you govern the business, across the way that you deal with your employees and your customers and clients, and your impact on the community and the environment. And they're the five areas that B Corp look to make sure you're upholding these high standards.
What does that mean for investment strategies? For example, have you had to divest from anything in order to meet this type of standard?
So we started on looking at ESG through our investments around 4 years ago. And we asked ourselves, should we have a separate set of green funds alongside our existing funds. And we then said to ourselves, but actually, if you believe in this, as we do, then all of your funds should have environmental filters. So all of our funds have environmental filters. We don't have a separate set of green funds. So ESG filters are core to what we do. It's the way that we only invest is through this way. So that does mean that we've excluded things like tar sands and thermal coal, etc. But we also want to see players in particular industries commit to a net zero path, a sustainable and believable net zero path. And as long as they have that sustainable and believable and verifiable path, then we'll continue to invest in them.
Obviously, ESG matters very important to investors now, but I'm also wondering, Peter, more broadly, when you talk with your colleagues and your clients, I mean, it's certainly an odd time in markets. What stands out as the big risks and fears that they're trying to deal with in this market environment?
Well, just on the ESG front, when everyone thinks of Coutts, we think of traditional wealth and landed estates. The core of what we do is we bank 20,000 successful and influential entrepreneurs here in the UK. And a number of those are already B Corp, and that's one of the reasons we started on this journey. So what we're looking to do is, once we get ourselves in a place we're comfortable and getting our accreditation, our plans to improve in the future, because you have to commit to improve in the future, we think we've got a real role to play to help as many of those 20,000 entrepreneurs join us on the path to B Corp. So that's the first thing. The second thing, though, is that being the first private bank and wealth manager, we want other private banks and wealth managers to join us on the journey, because this is not a competitive thing.
So, Peter, if I can kind of shift a little bit, what about inflation? How concerned are clients about that current environment?
Well, I know it's been a topic all morning for you, and there are views on either side of it. Is it real? Is it just passing? And I think the view in the middle is it's too early. It's too early to tell. When I talk to clients though about inflation, I really want them to think about how much money they've got in cash. So through the pandemic, people have not been spending, and you can see the deposit balances across banks have gone through, have really grown very strongly. So how much money do you have in cash? And what's the impact on your overall returns by having that money in cash? Because we know cash returns are low, if not negative, in some currencies. So for our clients, actually, I'm asking them to think about being invested, because it's about time in the markets. It's not about timing the markets.
Yeah, that's such a good point. I mean, looking at where real yields are, for example, there's not a lot of return from a lot of the bond space. So how are you seeing your high net worth clients put that cash to work? What kind of assets and types of instruments are they going towards?
Well, we're a multi-asset, well-diversified set of funds. And so we talk about, as I've already said, time in the markets, long-term returns, sustainable, reliable, sustainable returns. You don't come to Coutts for the latest IPO or the latest structured product. That's not what we do. We're looking after families' wealth for generations. So this is safe capital that wants to be protected and wants to grow faster than inflation, which means it needs to be appropriately invested across a broad range of assets in a cost-effective way. And increasingly, we're using a lot of passive vehicles to ensure that the cost of delivering that investment return, which we're very proud of, first quartile returns, we're very proud of our investment returns. And you'll see in our results in the next couple of days the growth that continues on our investment AUMs as a private bank and wealth manager.
Interesting. Also within the Coutts world, I mean, we've heard from a lot of banks that are facing this issue of talent retention. It means bonuses are getting higher, wages have been getting higher. What's the current picture and state of play when it comes to that at Coutts?
Well, being a purpose-led organisation, the NatWest Group is a purpose-led organisation wanting to help families, businesses and communities thrive. And Coutts, part of the NatWest Group, is a purpose-led organisation. That's what B Corp is all about. And I can tell you that's what our staff want to see. They want to feel as if they're working for a company that has a purpose. And as you probably expect, younger employees and younger staff members, that's probably a bigger issue for them as well. but it's a big issue for our clients as well. We've been pleasantly surprised in the communications that I've sent out to all our clients. The response back from clients has been really, really positive.
Peter, thanks so much for joining us this morning. That's Peter Flavel, CEO of Coutts & Co., which just received B Corp status. Now let's stick with the banking industry, and Credit Suisse's internal inquiry into the Archegos scandal paints a picture of severe due diligence failures. Bloomberg sources say that the review has found that the bank faced huge exposure for very little revenue. The Swiss lender lost about $5.5 billion from the collapse of Bill Hwang's family office. Credit Suisse is set to release the results of their investigation tomorrow alongside earnings. Joining us now, our finance reporter in Zurich, Marian Hofsmeyer. Marian, what can we expect in this report that we're getting tomorrow?
Hi, Danny. Yes, so I mean, there's no other way to put it. This is pretty scathing, and it really is showing that Credit Suisse is screwing up when it comes to really managing the exposure and the trades that they had with this client. So what we're expecting to see in this report is undoubtedly a little bit more explanation as to how this all happened and where the system broke down. Ourselves and other publications have been reporting about how they gave a lot of leverage to this client for little collateral and little revenues in return. And on top of that, there seems to have been a little bit of a breakdown in reporting about these risks upwards up the chain, where some key executives don't seem to have been aware of the largesse of the exposure that they were facing.
Yeah, with that in mind, a simple question, but probably not a simple answer. Who's responsible?
Yeah, definitely a simple question, but not simple answer. So we know a few have taken responsibility. The chief risk officer has departed. The heads of the prime brokerage unit have departed. The head of the investment bank has left as well. So definitely some people who have stepped down and taken quote unquote responsibility. However, we have to remember this is a huge hit. This is wiping out more than a year's worth of profit. It's still going to be dragging down earnings that will get results tomorrow as well. So it remains to be seen whether there's more responsibility to be taken here and whether, how they could even fix this.
Right. Marian, thank you so much. We'll definitely keep on top of these details, especially for tomorrow's release. That's Bloomberg's finance reporter in Zurich, Marian Hofsmeyer. Now, big tech beats, but fails to impress Wall Street. Apple, Alphabet, and Microsoft rake in $57 billion of quarterly profit, but they're warning that sales may slow down in the months to come. We're going to bring you all the details of that next. This is Bloomberg.
Billionaires in space?
What defines going to space?
There is a level where you
It's
get
the common mind?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around, and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing that I mentioned and you carried on talking and ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now turning to big tech, where profits have surged to unexpected heights, but the results failed to impress Wall Street. Microsoft sales beat for the 10th straight quarter, and Alphabet's revenue rose again. Apple also set records with its results, but warned sales may slow amid tight supply. Here to break down the latest results is Bloomberg Quick Take reporter Alex Webb. So, Alex, why was Wall Street just so underwhelmed after very strong results?
It's a slightly different picture for each company, but we do always often see that when these tech companies report really good earnings, and particularly in Apple's case, they didn't give any guidance for the upcoming quarter. There's some profit taking that investors think, well, is this as good as it's going to get? Maybe now's a good time to cash out. These companies are trading at fairly exorbitant multiples already. Slightly different picture with Google, which did give a more bullish outlook. It is an advertising company or advertising technology company. That means that as the economy recovers, people spend more on ads. Google is likely to track that to a greater extent than would Apple or Microsoft.
Okay, so does that mean big expectations then when it comes to ad revenue from Facebook?
It does. The thing with Facebook is that they are going to be under slightly more pressure than Google because they are dependent upon, to a great extent, Apple and Google's own Chrome browser to reach their audience. Both of those companies, Apple and Google, are cracking down from a privacy perspective, making it a little bit harder to track people across the internet, and whether that has an effect on Facebook's outlook, I think is going to be significant.
Alex, thank you as always. Wonderful to get your insight on a big earnings day for tech. That was Bloomberg Quick Take reporter Alex Webb. Now, Bloomberg Surveillance Early Edition will continue in the next hour. Matt Miller and Kaylee Lyons join me from New York. It is a market day where there is just so much to digest between the various earnings that Alex was just talking to us about, be it tech, be it the banking sector, as well as a Fed decision. So we have the meeting of the macro and the micro coming head to head as markets move nominally higher. This is Bloomberg.
E3 is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
When we institute mandates, you see vaccination rates go up, and I think it illustrates confidence in the vaccines because they are safe and effective. This should be a non-controversial vaccine.
This is one of the biggest factors behind the downgrade, the Delta variant. Now, we're seeing cases going up in the U.S. too, and other parts of the world.
We're taking nothing for granted in this environment, but that said, we don't see signs today of that being a major impediment. But again, a watch item to be sure.
This is Bloomberg Surveillance, early edition, with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Wednesday, July 28th. Our top stories today: Joe Biden's summer of joy turns into a nightmare. Blame the Delta variant and vaccine holdouts. Facebook up next. The social network reports earnings after some of the tech's biggest names beat estimates. But Apple warns that sales growth may slow. And European bank surprise, Barclays Investment Bank brings in a record haul, while Deutsche Bank raises its revenue target. I'm Danny Berger in London with Matt Miller and Kaylee Lines, both in New York. Francine is off this week, and it is a complicated day for markets, Kaylee. We are moving higher from here, but we have the merging of the macro picture with the earnings and the macro picture of a Fed. I mean, it's definitely a complicated market to navigate in.
Well, of course it is, Danny, and also this market has to consider the equation of China and the crackdown we are seeing on different industries there. That said, sentiment did seem to improve in the Asian session, at least in China and Hong Kong. You did have Japanese equities lower by about 1.4% on the day, but in China they closed higher by about 0.2%. You have state media talking up the markets, trying to stem the 3 days of losses. That seems to have worked for now. And the Hang Seng Index, the outperformer, up about 1.5%. The Hang Seng Tech Index also has seen a bruising last 3 sessions, down 16% in the 3 days prior to today, but a little bit of a recovery today, up about 3%. One stock also that had seen a lot of pain lately was Tencent. It, though, closed marginally higher, up about 0.3%. In foreign exchange, I would note we're also seeing a recovery for the Chinese yuan. It's the big outperformer in Asia today, stronger against the dollar by about 0.3% to right around 6.5. And then, of course, the underperformer is the Korean won. It's right around a 10-month low, weaker against the dollar by 0.4% today, as South Korea reports record COVID cases there. As for the picture here in the U.S., we did see some selling yesterday. Actually, the worst day for the NASDAQ 100 in about 2 months. A bit of a recovery taking shape in futures this morning, though, ahead of that Federal Reserve decision. Right now, S&P 500 futures up about 8 points. In the bond market, we're seeing the yields tick slightly higher, up 1 basis point on the 10-year to just around 125. And real yields ticking up as well from those record lows that we saw yesterday, right now around negative 112 basis points. Finally, Matt, I feel like I went a long time without talking about Bitcoin, and now I seem to be talking about it every day because it is moving higher for the 8th day in a row, up 4% today, on pace for its longest winning streak of 2021 thus far, just under that $40,000 level.
Well, when it's hot, and that's why we're paying more attention to it now. For a while, we were worried about a crash. Now we're talking about 50,000 again on Bitcoin. But really, I think the focus, especially in Europe, is on bank earnings, on Barclays, on Deutsche Bank, on Credit Suisse and Archegos. We have gains across the board, but they're not huge gains. We're looking at bigger gains in Spain and in France than we are in Germany. That's really fascinating because Deutsche Bank shares aren't gaining. Normally, you know, you'd think they raised their revenue target. We should see shareholders give even more trust to Christian saving. After all, he's done really well with his turnaround plan, but costs are higher, and maybe that's one of the concerns. Here you see the FTSE 100 gaining about 0.2%. The Stocks Europe 600 up about 0.4%. of 1%. So there are some gains. They're just not really big. Barclays is a bigger gainer. I think it's up about 4% right now, Danny. So Barclays is really, I think, the winner story today. The loser story could be Credit Suisse. Can you believe Archegos gave Bill Wang, tens of billions of dollars in exposure and didn't generate any revenue from it? Almost no revenue. I mean, how did that happen?
I thought it was supposed to be high risk, high return. I don't think what you learn in the CFA is high risk, no return. I think someone's got that equation wrong, Matt.
Yeah, it seems to be a failure that we're going to learn a lot more about tomorrow when we get that report. But I think bank earnings are front and center. And then, of course, we got to focus on the big raft of tech earnings we got. And, of course, we're going to talk a lot about whether or not vaccinated people have to wear masks indoors.
Right. And of course, within those earnings, we also have the concern about inflation. A lot of things to dig through. And look, we have a lot more ahead today as well, Matt. So let's take a look at what's ahead. We'll get second quarter earnings from Facebook and Ford. Pedro Castillo also takes office as Peru's new president, and that follows weeks of vote recounts. Then at 10:30 a.m. New York time, the EIA releases its crude oil inventory report. Crude, of course, very important after last month's dust-up between OPEC. And then the biggest event of the day, hopefully there'll be some excitement in there, the Fed rate decision at 2 p.m. And that, of course, is followed by a news conference from Fed Chair Jerome Powell. So a lot to look out for today. Now, the virus has also been front center when it comes to the Fed and really for the entirety of these markets, because call it a reality check for the whole world. The U.S.'s reign as the best place to be during the COVID era, it really did not last long. Its vaccination drive has stalled, and there's been a new surge of cases. So Norway now is the new #1 in Bloomberg's COVID resilience ranking. It has enough shots administered to cover almost half of its population, and its borders are open. Coming up second is Switzerland, followed then by New Zealand. At the bottom of the 53 countries ranked is Indonesia, where more than 1,300 people are dying of COVID every day, and there aren't enough shots for a large population. That reinforces a rich-poor divide in the rankings. Bloomberg's COVID resilience ranking comes as the CDC also reverses its mask guidance in a bitter setback for President Biden. Sam Fazeli, Bloomberg Intelligence Senior Pharmaceutical Analyst, joins us for more. So, Sam, is it just logical then, if we have the U.S. falling in this ranking, that we then would need a mask mandate put in place for many places across the country?
Yeah, I think the two do go hand in hand together, because at the end of the day, it's all to do with the Delta variant, which is, like everywhere else, has taken hold in the U.S. and pretty much close to 90% of cases based on some of the data that I look at. And it is a variant that when you catch it, makes you, at least at the beginning, have much higher amounts of virus in your respiratory system. So vaccinated or not, if you catch it, you're more likely to pass it on. So it does make sense that the CDC goes with what the data suggests.
So essentially, if I'm a vaccinated person, I'm just wearing my mask to protect those that are unvaccinated, Sam? Is that really what is going on here, or am I a vaccinated person at risk?
Well, some people laughed at me when I said I continue to wear 2 masks when I'm out in spaces where I'm not sure who's vaccinated or not. This is all to do with the Delta variant. If I'm going to be faced with somebody who's got 1,000 times more virus in their exhaled breath, it's more likely that I'll catch it if I had 1 mask. Certainly if I had no mask, if I had 1 mask. If I have 2 masks, it just continues to reduce my risks. So
go for 3 or 4.
5, 6. No, but look, at the end of the day, there has to be some limit, because I still also need to breathe. So, but certainly, I think it all goes hand in glove. It is entirely to do with the characteristics of the Delta variant.
Sam, thanks very much. Bloomberg Intelligence's Sam Fazeli talking to us about the mask mandate news. In earnings news, back to earnings news, Deutsche Bank is raising its 2022 revenue target. We spoke with the CFO, James von Moltke.
We've implicitly updated our revenue guidance for 2022 because the numbers that we shared with investors in December for each of the core business units, they're either running in line with or ahead of. That gives us real confidence going into next year. We also see much less of a headwind, even in today's interest rate curve, relative to what we had planned on as far back as November, December. So we see really bullish signs for performance above the 24.4 billion that we called for 2022 when we shared those numbers with investors in December.
Bloomberg's Juliet Sally joins us now with a breakdown of what we've heard from a couple of European banks and what we're preparing to hear from another. Juliet?
Indeed, Matt, you said it before. Of course, these bullish signs that we just heard, they're really going to set Deutsche Bank up for that positivity. You've got shares, though, fairly unchanged at the moment. What was really interesting, though, was what was happened in their fixed income trading. It fell by 11%. That was a lot better than its peers, including Barclays, which actually saw its fixed income trading revenue fall by 39%. Barclays, though, is seeing 2021 costs above 2020. And importantly, they announced this £500 million share buyback, which is supporting its shares up by 3.7%. They have been up by as much as 4.7%, the most since March. We were also speaking to the CFO of Banco Santander on European Market Open, talking there about the beat here, net income coming in at 2.1 billion euros, and Chairman Anna Batan saying that Banco Santander, Danny, is on track to outperform its profitability targets for the year.
Yeah, I mean, just even looking at that performance, very uneven among the banks. And I mean, speaking of idiosyncratic risks, Bloomberg learning some news out of Credit Suisse and Archegos about the very little return they would have gotten from Bill Hwang. So what do we know at this point, Juliet?
Yeah, you put it really well there when you were saying, or what do you do in terms of high risk and no return here? Because we are hearing from this internal report from Credit Suisse that the bank basically failed to gauge tens of billions of dollars of exposure to Bill Hwang's family business that was basically providing little or no return. Now, the actual report is likely to be made public by Credit Suisse itself tomorrow, but we know that this has caused a litany of potential due diligence failures here and has led the bank to a lot of head scratching. We've already heard that Chief Risk Officer Lara Warner has left Bloomberg, breaking the news yesterday that she will be replaced by Goldman's David Wildermuth, and there could be some potential more changes ahead, according to Bloomberg Intelligence here too. Goldman is one of the banks that had little exposure to the Archegos fallout, which of course we know hit Credit Suisse's prime brokerage business pretty hard, Kaylee.
All right, thank you so much to Bloomberg's Juliet Sally with a big recap of all the European banks there. And I want to recap the big tech earnings we got after the bell last night. Those are the stocks I'm focused on in pre-market trading here in the U.S. today. Of course, the three of them we got combined represent $6.5 trillion of market capitalization, the biggest, of course, being Apple. The issue with Apple isn't the quarter it just reported. Record revenue of $81 billion, well exceeded analyst estimates. Thank you very much, to 50% growth in the iPhone. The issue is that the company warns of slowing growth, and specifically supply constraints, aka the chip shortage, weighing on iPads and iPhones. Plus, they say services demand may slow down, so that is dragging the stock lower by just about 1% in early hours. The other $2 trillion plus company, of course, is Microsoft. It beat on both the top and bottom line for the 10th quarter in a row. Revenue up 21%. A bit of an issue with its cloud computing business. It, on a constant currency basis, did see growth slowing. That initially had weighed on the shares, though investors now seem to be focusing on those beats, with the stock up just about 0.4% in early hours. And finally, the big winner of the three tech giants that reported yesterday was Alphabet, of course, Google's parent company, really benefiting from the rebound in ad sales as the economy reopens. And YouTube saw ad sales up 84% in the quarter. Plus, you had the cloud business beating expectations as well. All of that together giving a nice lift to those shares, up the better part of 4% in early hours, Danny.
And Kaylee, these are also so important if you just hold the index. I looked at HMove on your terminal, a great function to see how much each stock has moved the index. Apple alone this month, 17.5%. It's responsible for the move in the S&P 500. So very important to keep an eye on those moves. And we'll continue to do that. Coming up this hour, we have James Athey, Aberdeen Standard Investment Director. And later on in tech earnings, we have Eileen Burbidge, Passion Capital Partner. And after that, on the virus, we have Dr. Gigi Gromval of Johns Hopkins. This is Bloomberg.
debate happening in the business world right now is how to get workers back to work and what benefits to give your employees. Microsoft is asking employees to be back in the office 51% of the time, but you're flexible about the rest of the time. Is that a permanent policy? And for those companies that are saying you have to be back in the office 100% of the time, are they on the wrong side of history?
I think we at Microsoft, we want to be much more data-driven. I also think that in time, if a year from now, we will have more sense of what the real structural change and needs and the expectations of both our employees and our customers are. And we'll really think about long-term policies based on, quite frankly, having all of that data behind us, because otherwise I think we are trying to come up and being too overly dogmatic when I think we need to be more experimental in our approach to return to work, because I do fundamentally believe the world's changed.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York. Danny Berger is in London. Francine is off this week. I don't want to lose sight of the China story because it continues to develop steam. Now they're starting to clamp down on real estate after dealing with fintech and ed tech. And what I'm looking at here in this chart, and I want to welcome our listeners on London DAB Digital Radio. I remember to do that every time I pull up a chart because you can't see it, but I'll walk you through what's here. The FTSE China A50 index is the blue line, and it's been rising over the last couple of years until the big drop that we're witnessing now. And you can really pick any Chinese index. They've gotten absolutely slaughtered as the Communist Party starts to clamp down on these capitalist companies. Now, it's also got the MSCI World Index, which continues to rise and doesn't look like it's been affected by the drop in Chinese stocks. But the last time this happened in 2015, it took a few months before global stocks recognized what was happening in China as well, and then followed with another drop. Let's bring in James Athey, Investment Director at Aberdeen Standard Investments, to ask the question. Well, first to say good morning, James. Good morning to you. And then I'll ask the question, is what we're witnessing in China going to eventually affect global risk assets?
And morning to you, Matt. Yeah, it's a good question. The honest answer, of course, is I don't know. I think one of the features of the let's call it post-crisis financial markets, so it's probably been going on a bit longer than that, is just the extent to which certain asset classes have desensitized themselves to sort of marginal changes in the news flow. And so what you need is a build-up of counter consensus news, I'm going to call it realistically. I mean, bearish news. You need a build-up of that news before markets feel compelled to act. We even saw that in the first quarter of 2020, where even as it was becoming immediately obvious that this virus is going to be an issue, equity markets didn't react. We saw the same in 2007, even after we'd seen problems with gating of funds and even the default of Bear Stearns. You still didn't get equities reacting until much later in the process. So it
James,
wouldn't surprise me if there is just a lag.
Talking about a lagging reaction to the virus, when you think about the Delta variant, do you have to recalibrate your growth expectations?
Me, no, because I think my view is that the market was taking an incredibly rosy view. At the back end of last year, at the beginning of this year, I just felt that the market consensus view had no slack in it whatsoever, no redundancy, no risk premium at all. It was essentially priced at the upper end of the distribution based on all of the inputs into that growth forecast. My view was, just from reading and understanding our history with viruses, was that it was more likely that this virus would linger and continue to have a negative impact on the economy for a bit longer than the market was expecting. But yes, in terms of asset prices, you should expect that there should be some reaction. But again, in US equity markets, it's very difficult to observe that reaction at the headline level. You see it more in sector rotation.
Let me zoom out a little bit then and talk about EM, because yesterday I was speaking with IMF's Gita Gopinath, who said, look, in 2025, the U.S., the advanced economies, they won't have any scarring, but because of the divergence in vaccines, emerging markets still will. What do you do with EM at this point, James?
I mean, I dislike it. I disliked it anyway. I dislike it more today because I think the dollar dynamics have changed. I think the dollar is one of, if not the most important inputs into your EM investing thesis. I mean, big picture, EM had an opportunity with China's building program, let's call it, throughout the 2000s, and particularly post the crisis. EM had an opportunity to fix their roofs while the sun shone. They didn't. They got even further indebted at a time where they were really benefiting from this one-off shock of commodity demand from China. So right. I see structural weakness there. I see a lack of a growth model. And once the dollar starts rallying, that's never a good thing for EM.
James, one more quickly from me. It is Fed Day. What is the #1 thing you are looking to get out of the Fed and the chairman today?
Oh, great. I mean, the #1 thing I'd like to get is some clarity and understanding of what on earth their reaction function is and why on earth they're still buying 120 billion of assets with growth at 8% and inflation at 5%. But I doubt we'll get any of that. So I think Jay Powell wants this to be a pass. He wants this to go off without a hitch. There's no new dots. There are things happening in either direction, high inflation prints, but markets are repricing as if they're worried about growth in the future. He doesn't really want to validate either side. So I think he'll try and be very cautious, very centrist, some positives, some negatives, and hope that the market isn't too destabilized by either.
I expect he'll say the word patient a lot today. Thank you so much, James Athey, Investment Director at Aberdeen Standard Investments. And be sure to stay with Bloomberg for our coverage of that Fed rate decision and the news conference from Jay Powell. That begins at 1:30 p.m. in New York, 6:30 p.m. in London. This is Bloomberg.
I've always sort of pictured what it was going to be like. I mean, like the ride up there, the ride back. And I never realized that the whole experience was going to be so vivid.
But beyond sort of the satisfaction of your own goals being achieved, what does today symbolize for the company and also for all those children that were present earlier?
Well, look, for the children, we've just got to get building as many spaceships as we can, as fast as we can, so that one day those kids will have the chance to have a similar experience to what I had. And that we will do. We also launched this giant global raffle today, so that, two kids for, just $10 for a pair of tickets. If they could win the raffle, they can go up. But that money will hopefully enable many, many people to be able to go up who could never have dreamt of going to space.
Up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York. Danny Berger is in London. Francine Lacqua is off this week. Now let's get the first word news. And two key U.S. senators say they have reached a bipartisan deal on spending more than $2 billion to pay for security at the Capitol. The money also would be used to resettle Afghan nations who helped American forces. Senators Patrick Leahy and Richard Shelby are pushing to get the bill passed by the end of the week. It would reimburse Capitol Police and the National Guard for the money spent in the January 6th riot. In China, the government will up the stakes after trying to tame property prices for years. It's attempting to break a cycle of gains that has made homes increasingly unaffordable. In recent days, China jacked up mortgage rates in a major city and vowed to accelerate the development of government-subsidized housing. It also plans to increase scrutiny on financing of developers and title transfers. The British government is about to end the quarantine for visitors from the U.S. and European Union. That is if they have been fully vaccinated. Instead of isolating now, those travelers would have to take COVID tests before leaving for the U.K. and after they get there. And at the Summer Olympics, U.S. gymnast Simone Biles won't defend her title in the individual all-around final competition. She withdrew from that event today, a day after she pulled out of the team final. According to USA Gymnastics, Biles will focus instead on her mental health. The organization says she'll be evaluated daily to see if she will take part in next week's individual event finals. And coming up next, Eileen Burbridge, Passion Capital partner, will be joining us to talk all things big tech. Apple, Alphabet, and Microsoft out of the way, Facebook on deck today, and of course Amazon reporting tomorrow. We'll break it all down. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Matt Miller and Kaylee Lyons alongside me, both in New York. Francine Lacroix is off this week. Guys, it is a big week for tech earnings, but Matt, within all of that, we also have Robinhood's IPO on deck. Just yesterday, I love this, the Bloomberg team looking through new code at Robinhood saw that they're working on features to allow you to invest your spare change.
Yeah,
I don't know exactly what that looked like. It sounds interesting.
Like acorns, basically. I think it's pretty interesting, and it'll be fascinating to see how the IPO goes because, of course, they're going to give a lot of it to retail investors in a move that is very un-Wall Street. You know, typically you put these shares into syndicate and big brokers give their big clients a bite. But now retail investors are going to be able to get some. Of course, it's going to be much riskier than many previous IPOs, but you still may see that pop, and that's what retail investors are hoping to take part in. I also like the ticker, HOOD. Not sure if that's a good ticker or a bad ticker. Do you want to be invested in Hood?
I don't know. I think it's cool. I just think anything that you can just say and not have to say each letter, that's kind of the way it goes. You get some nice status from having a word as your ticker. It's like license plates, you know? You want a cool one. But away from the IPO market, Kaylee, what else is going on here? I mean, are we all just kind of waiting and seeing what comes out of earnings in the Fed?
Yep, 2 p.m. Eastern time for that Fed decision, and of course more mega cap results coming after the bell today and tomorrow. So it is a lot for the market to digest on top of the situation in China, which really roiled equities earlier this week. That is not the case, though, this morning. As we await that Fed decision, we are seeing stocks in Europe and the U.S. right around session highs. Right now, we're up about 0.5% on the stock 600 in Europe. And here in the U.S., of course, it was the NASDAQ 100 that underperformed yesterday, down a little more than 1%. Actually, its worst day in about 2 months. Today, though, those futures are actually outperforming, up by about 0.3%. In the bond market, as traders await any kind of clues we may get on tapering, when and where it starts, of course, up 1 basis point on the 10-year yield. 125 is where we sit. In Bitcoin, meanwhile, heading for an 8th consecutive day of gains, the longest winning streak of the year thus far, up about 4.6% to just under $40,000. Of course, it also is earnings season. We got a number of reports after the bell yesterday, and not all of them were positive, Starbucks being one. Yes, you saw global same-store sales up 73%, beating expectations. China, though, did not beat expectations. Actually, a slowdown there is causing some concern. That stock down about 2.3%. And then, of course, we got that trio of mega cap results after the bell. For Apple, the concern isn't about the quarter that just reported with 50% growth in the iPhone. It's the fact that it says it will slow going forward, and they didn't actually provide a quarter forecast for the current quarter. That stock down 1%. Alphabet, though, up the better part of 4%. It beat across the board on everything, really benefiting from a rebound in digital ad sales. And then Microsoft also beating expectations. A little bit of a slowdown in the cloud computing business, but not weighing too heavily on the shares. They're up by about 0.25%, Matt.
Listen, Dan Curtis, who is our award-winning producer here in New York, I think he's like an Olympic-level rower as well, put together this chart for me. Yesterday, we had $9 trillion in companies, U.S. companies, reporting earnings. But what this shows, and I'll describe it for our listeners on London DAB, is that every quarter they beat by more and more, or more companies, I should say, in the S&P 500 beat the street's estimates. 88.5% of companies that have reported earnings so far have beat the street. This chart goes back to 2012, and we just continue to hit new highs. My question, Danny, is that because companies are just doing better and better, or is it that analysts are just not challenging them enough?
Interesting. I mean, we have seen analysts a lot of times scramble to catch up with the earnings, upgrading after upgrading. But Matt, I think that picture and all those upgrades bring us this fear of, have we reached peak earnings? It's very real this season.
Yeah, well, I mean, I just think that they're not trying hard enough. You know, I mean, why don't you just take whatever your estimate is and raise it, add another 25%?
Shut it down, Danny.
They're
Shut it down.
Yeah. Is that I love that. That's the model. Take what you got, add 25%. Doesn't matter the company, the industry, you know, that's the way to go. Well, anyway, look, we have big tech profits surging to unexpected heights, but the results did fail to impress Wall Street. Apple warned that sales growth may slow and supplies are getting tighter. Let's hear from Apple CEO Tim Cook on the impact of 5G.
We're only in the early innings of 5G, but already its incredible performance and speed have made a significant impact on how people can get the most out of our technology.
Let's get more into these tech earnings. Joining us now is Eileen Burbidge, partner at Passion Capital. Eileen, first off, thanks so much for joining us this morning. So have we seen the peak growth at Apple? Is it all downhill from here?
I think I remember having that question asked to me maybe 3 or 4 years ago when I was on with Fran here in the London studio. You know, I think it's not the peak. I think what we're seeing with all of these results and coming out of the pandemic is that tech is definitely no longer its own isolated sector. It really does reflect the greater economy. I think it was Satya Nadella who said that it's 5% of global GDP. We're seeing that, you know, services, delivery, advertising, eyeballs, any kind of product, it's being digitized, it's being served online, and it's being served by the big platforms primarily.
I wonder, you know, when I used to live in the U.S., Apple had a history of crushing the street's expectations and then really disappointing on the outlook. I thought they were just constantly under-promising and over-delivering. Is that what they're doing now, or are there really big concerns about supply chains and chips?
I mean, I think, you know, I really like sort of Tim Cook's approach, you know, that he's sort of cautioning, listen, we might not be able to maintain this for the current quarter. It does seem to be pretty extraordinary. And I think he's acknowledging that and sort of saying, listen, you make all the guesses you want, you make all the predictions you want. We're telling you what we're seeing, which is supply chains got to catch up. And he also made the comment that their quarter would have been even stronger had they not had supply chain issues. So he's sort of saying this could be a problem. Having said that, you know, the stock performance and the reaction after the results came out, yes, they dipped a bit, but that's because they'd already had a run in the couple of days right before the earnings came out. So everyone was already anticipating this was going to be a pretty blockbuster quarter.
Well, Eileen, that brings me to a question. Matt Miller and I yesterday were laughing about the fact that we're now talking about $2 trillion companies. I mean, it's an unbelievable number when you think about the market capitalization of stocks like Apple and Microsoft. Is that really justified given what we are seeing out of these reports?
Well, I mean, if you look at the combination, I think I saw of Apple, Google, and Microsoft, they were generating revenue of $5 billion a week in aggregate during the quarter. I do think that justifies $1 trillion sort of valuations. It doesn't really surprise me. You have, you know, just YouTube alone within sort of the Alphabet portfolio generating $7 billion of revenue from advertising in the quarter. These are big, big numbers. So the valuations are based on revenue. They're based on top line, and they're also based on EBITDA. So I don't think it's, you know, it's completely irrational. Obviously, everyone continues to price in future earnings and potential as well. But so far, it doesn't seem like that's actually irrational.
I wonder then how much you would read into, of course, say for Alphabet, which did move higher after its earnings, the big tech giants falling after they report. Can you just kind of step back and say, okay, I don't really care about the action today, just because they are trading at frothy levels?
Well, I don't know that I would say I don't care, but they're definitely frothy. I agree with that. I think what's interesting is that everyone gets so excited anticipating the results that you see the run up in a couple of days before the results, and then people go, okay, that's exactly what we expected, or I knew that was going to be the case, and then they take their gains off the table. And so I think that's the trend that we're seeing. Whereas before, maybe you had people waiting until the results came out. Now people are saying, you know what, I think this is going to be a good quarter, and trying to get in before the results come out. But that is sort of preempting everything, and that's why you had the dip on the Apple side. I don't think, though, it's necessarily reflective of sort of, you know, reality as such. It really is about the level of enthusiasm before the announcements and then right after the announcements.
You know, in terms of Amazon, I spend more time now just looking for stuff that I might need. Plus, I have subscriptions for like toothpaste and paper towels. I'll never go back to buying those at the store. How much of the pandemic behavior that we've picked up from lockdown is sticky?
Oh, I think much of it is. I mean, if you look at, you know, food delivery services, you look at consumption of, you know, for instance, even what's happening with the Olympics and how much sort of digital broadcasting has taken over sort of traditional broadcasting. You know, people are still, you know, really exhibiting the behaviors that we had from lockdown. So we're not back to normal as such, especially here in the UK, I don't think, as compared to, say, Florida in the States. And I do think a lot of habits that people picked up working from home, it's not going to necessarily go back to normal just like that overnight. Certainly as we start to see, Delta variant kind of take hold in various countries, even with travel restrictions lifting, I think people are still going to take the convenience that they got online and the sort of comfort they got with services and product delivery online from the pandemic, and they'll take that forward for a long time to come.
All right, Eileen Burbage, partner at Passion Capital, thank you so much for your insight today. And coming up next, we'll have some insight on the pandemic and the CDC's new mask guidance. Dr. Gigi Gronvall, Johns Hopkins Center for Health Security Senior Scholar, will be joining us. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The curtain will rise again.
Broadway's returning June.
Have you bought tickets?
Is busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, U.S. Commerce Secretary Gina Raimondo. That's coming up at 10:30 a.m. Eastern, 3:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Danny Berker in London. Francine Lacqua is off this week. Well, on July 4th, President Biden declared America's independence from the coronavirus. 3 weeks later, and that sense of victory is evaporating. The U.S. now faces a surge in cases fueled by vaccine holdouts and the highly transmissible Delta variant. That reversal of fortune is prompting the CDC to reverse its mask guidance and recommend that some vaccinated people wear masks indoors.
We believe the vast majority of transmission is occurring in unvaccinated people and through unvaccinated people. But unlike the Alpha variant that we had back in May, where we didn't believe that if you were vaccinated, you could transmit further, this is different now with the Delta variant, and we're seeing now that it's actually possible if you're a rare breakthrough infection that you can transmit further, which is the reason for the change.
Dr. Gigi Gronvall, Johns Hopkins Center for Health Security Scholar, joins us now for more. So, Dr. Gronvall, basically this is to protect unvaccinated people and vaccinated people from then infecting those who are unvaccinated. But if even vaccinated people have to wear their mask, doesn't that remove some incentive for those that haven't gotten their shots yet? Why would they do it if they're still going to have to mask up?
Yeah, I mean, it's really unfortunate that, you don't get that benefit of being vaccinated and going without a mask. But, right now, we don't have the vaccination rates that we need to have to be able to put that incentive back. And with Delta, it's more transmissible. It looks like people who are infected have a lot more virus in their nose, so they're breathing a lot more out. And so with kids being unprotected generally, it's really kind of what has to happen.
So I have seen a lot of studies, Dr. Gronvall, pointing out that kids don't get severely ill from COVID, as well as the fact that the vaccinated don't get severely ill from COVID. I don't know any numbers, specific data backing that, but can you tell us, for example, what are the chances of me as a vaccinated person, or say my nephew who's 11, getting severely ill from COVID?
Yeah, so I mean, kids do much better than adults, but I think that if we had no adults or no seniors who are afflicted with this disease, people would be pretty concerned about the effect that it has on kids. There are kids, 1 in 1,000 infections that get long COVID. We don't know what's going to happen in the future. There's a lot of unknowns with this new virus. So what are we going to see 20 years, 30 years, 40 years down the road? And so I think the kids need to be the most protected group here. And I would love to see vaccine accelerated for children, because I think now the risks are higher to be unvaccinated.
A lot of uncertainties, of course, but I'm wondering if there are any lessons to be learned from the Delta variant as it spread in India. Began in March, it peaked, it ended around mid-May in terms of the peak of the severity. Could we look at that model and say, okay, the CDC guidance for more masks, just how temporary or long will that need to happen?
Right. We're already seeing some dips in the UK and Israel. So, I mean, clearly these public health measures are working. I'd like to see a lot more vaccine, though, a lot more people taking up the vaccine. So we're starting to see more mandates, workplace mandates. I think that's an excellent idea. The time for the carrots are still there, but we need to protect the people who are can't be vaccinated, and give the people who have already stepped up a break.
Doctor, you mentioned Israel there, which is one of the places that is now offering a third vaccine shot to people who are immunocompromised. You also have places like the Dominican Republic now offering a third shot to people. Is that something that here in the U.S., the Biden administration and the CDC should be more seriously considering?
I think it is under consideration for certain groups of people. So people who have had liver transplants, for example, they may benefit from a third shot. And a lot of people have already taken this advice on the advice of their doctors. But for most people, the shots that we have are sufficient. We need to be doing more to make sure that we vaccinate the world, because we're just going to keep going through this as long as we don't make more of the global population immune.
Dr. Gronvall, thank you very much for joining us. Dr. Gigi Gronvall there of Johns Hopkins. By the way, the Johns Hopkins Bloomberg School of Public Health is, of course, supported by Michael R. Bloomberg, and he is the founder of Bloomberg LP and Bloomberg Philanthropies. Coming up in the next hour, more on the virus with Dr. Bhakti Hansodi, Johns Hopkins Associate Professor of Emergency Medicine. That's at 6:30 a.m. in New York, 11:30 a.m. in London. We all want to know as much as we can now that those of us who are vaccinated may have to go back to wearing masks indoors. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I'm really enjoying my life at Netflix right now. You know, I feel like we've just gotten started there. And, you know, I can't wait to keep building on that and enjoy that, making new shows there, working, you know, building on our podcast world. Enjoying those worlds is exciting to me.
That was Shondaland CEO Shonda Rhimes, of course, the genius behind shows like Scandal and Bridgerton. And you can watch that full interview tonight on the David Rubenstein Show, Peer-to-Peer Conversations. That's at 9 p.m. New York time. And it's time now to chat with Tom Keene, co-anchor of Bloomberg Surveillance, who's joining us now. So, Tom, it's a big day. We're digesting big tech and, of course, waiting for the Fed. What are you focused on?
Well, I'm focused on Jay Powell's going to say, look at American technology. It's world-class and world-leading. Yes, the Fed's important, but I think the underplayed is what we've just observed with these three tech companies, what we're going to see with Amazon tomorrow, Kaylee. The chart's real simple. It's just a normalized chart of Apple, Google, and Microsoft. Not all that informative other than the massive Apple outperformance. We all know they've done better than anybody else. The revenue build, Kaylee, in the big four, Microsoft, Google, Amazon, and Apple, from 2019 to 2022 is the size of Apple's revenues in 2019. That's how fast they're growing.
Wow.
They've grown, you know, based on the estimates of 2022, they've grown in Apple in 3 years.
I'm looking at, Tom, I'm still focused in on what's going on in China. We've got this continued clampdown reaching further and further out now into real estate, and it's not great for Evergrande. But you also see the yuan continue to fall. When does the rest of global Wall Street start to catch up to this?
Well, I think they're on the story, Matt, but you make a very good point. It's tangential, and what's really important, Matt, is glasses in China are a boom business. They're probably keeping Beijing in power right now, the manufacturer of black plastic glasses. It's a great and beautiful thing. It's a really serious issue, and as you know, Matt, it all goes back to property in the one way that Chinese can invest. We have to remember their capital flows are nothing like ours. I think underplayed is the artificiality of their markets, and all we've got left to look at is renminbi 6.50 today, a little bit weaker over the last couple days.
All right, Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. And for our London DAB digital radio listeners who did not just have the pleasure of seeing Matt Miller doing his best Tom impression with his black rimmed glasses, I encourage you to check it out on the Bloomberg Surveillance Twitter. We'll post it for you. Now time for a look at what else we are watching. And Matt, cars.
Yeah, I'm watching Ford. I mean, we have seen such incredible sales growth with these car makers, and really they've sold out a lot of them. You just can't find, for example, a Mustang Mach-E on dealership lots. They've gotten incredible pricing power. Sometimes we're looking at $10,000 or $15,000 over sticker price. This is the new Ford small or medium-sized pickup truck, the Maverick, which has been, at least on social, an incredible hit because it starts at something like $20,000. But this is going to be great because we know we're going to find out more about how Americans are spending their savings, and we're going to find out more about inflation. The Fed should be paying attention to this, and the supply chain issues.
I just want to know when you're buying that electric F-150, Matt. When is that happening?
It's going to be a little while because I still think this is the last chance I'm going to get to buy a big inch V8. So my next purchase will be a 6.2 liter or 6.4 liter V8, and then I'll start going electric.
Yeah, get the double V8, Matt. All about that, definitely. Rev up. Well, look, I am watching Facebook earnings. We had a lot of the big tech already yesterday. The bar is set so high for them just because advertising revenue has hit it out of the park when it comes to Twitter, Snap, Google, all of them delivering really strong results. So Facebook needs to show up. And we saw with Apple earnings, for example, it takes a lot for investors to be impressed this quarter. So after the bell today, Facebook, that's what I'm watching, Kaylee.
All right, and about 2 hours before that, Danny, of course, we'll get the Fed decision, which is what I am watching. Of course, the Fed's going to talk about tapering. It's probably not going to make any moves in that direction yet, but discuss when and where to start. And especially with inflation expectations coming down, yields coming down, and the risk around the Delta variant going up, I would expect that Jerome Powell and co. are going to use the word patient a lot, especially in that press conference later on. And of course, all of this decision today is setting us up for Jackson Hole next month, which I feel, Matt, is what the market really is going to care about.
I think they're really going to just push forward, try and punt to Jackson Hole because they probably don't want to roil markets any more than they need to at this meeting.
Yep, 1 month from today, Jackson Hole. We'll all be waiting for it, but of course, waiting for that Fed decision at 2 p.m. Eastern time. They will be talking about that on Bloomberg Surveillance. More of that is ahead. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Billionaires in space?
What defines going to space?
There is a level where you
It's
get
the common
into-
line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing
This
that I
is a
mentioned and you
big
carried on talking
physics
and
thing.
ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio.
Growth is going to slow. To some extent, that's a bit inevitable, though.
It's important to keep in mind that this cycle has basically been proceeding, very, very fast.
We're already in that decelerating upward revision pace, and about half the sectors are contributing to that right now.
This kind of economic strength, while it bodes very, very well, doesn't necessarily mean that corrections don't happen.
The reality is we're going to continue as an economy and globally and domestically to deal with the pandemic.
This is Bloomberg Surveillance. Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is Fed Decision Day from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures up 0.2% on the S&P. Before we even discuss the Federal Reserve, Tom, we need to talk about big tech in America. Blowout numbers from the big three.
I think they're linked together. Chairman Powell's worried about two Americas. Well, you know what, John? There is a partition in corporate America. There is a partition in the markets. There are these extraordinary companies we're going to dive into through today and into Amazon tomorrow, and their impact on America and, yes, on the Federal Reserve is tangible.
Tom, I think they're linked together as well. Take the earnings over at Alphabet. Cyclical demand really robust. YouTube, ad revenue up more than 80%. Yeah. Then look to Apple. What are they warning about? Decelerating growth and supply constraints persisting. That's exactly the conversation economists are having at the moment, Tom.
I go directly to where you were, John. I was sitting there yesterday in the cave looking at the earnings after the surveillance nap, and the YouTube revenue growth speaks volumes about not only Google, but the whole industry and also the media business as well. YouTube's breakout numbers are just jaw-dropping.
Lisa, as Gene Munster would say, you've got the business and then you've got the stock. The stocks tell a slightly different story this morning.
Yeah, although you do have to wonder how much just was priced to perfection. But Apple shares getting the biggest hit, basically with the expectation that perhaps the forward projection shows a slowdown due to some of the supply constraints, due to some of the other issues like the iPhone cycle and where we are in this. Nonetheless, to me, the numbers were stunning. 30% bigger revenues after taxes for the big three in the tech world. And Satya Nadella of Microsoft saying 5% of the world GDP is tech spending. It's projected to double, and the doubling is going to happen at an accelerated rate, John.
New revenue records in each geographic segment for Apple. We'll be talking about those names in just a moment. Let's whip through the price action for you. Starting with equity futures in America. On the S&P 500, we advanced 0.2% on the S&P, up 8 or 9 points. Into the bond market, going into a Federal Reserve decision and Chairman Powell news conference, 125.60, yields higher by a basis point or two, and euro dollar unchanged, Lisa, euro dollar 118.18.
Yeah, and I'm curious to see whether the Federal Reserve meeting later today is actually going to provide us any new information. A lot of people, including Mohamed El-Arian, expects no drama given all of the uncertainties around the Delta variant. 8:30 a.m. we'll get the insights from Joseph Stiglitz of Columbia University, a professor, Nobel laureate in economics. And not only are we going to be talking about inflation in the Federal Reserve, but also the implications of exactly what you, John, and Tom are talking about. The big getting bigger, the behemoths of big tech, and what the implications are for the overall economy. 2 p.m., that Fed rate decision that we're talking about, and then perhaps more importantly, 2:30 p.m., the press conference with Fed Chair Jay Powell. I want to hear what he says about inflation. Is there any change in the rhetoric around transitory, transient? Are they starting to soften that sort of security and the idea that this will pass? And given that, how much are they setting up a discussion on tapering their monthly bond purchases at the August meeting in Jackson Hole? And then aftermarket, the churn of tech earnings continues. Facebook coming out with their second quarter results. Very interested to see whether they mirror what we saw over in Alphabet and Google with respect to ad spending, because that really was, to me, the standout figure, the slew of earnings that we got last night, John.
Lisa, thank you. This started last week with Twitter and Snap, Tom, and you'd have to say, once again, as Lisa points out, really Alphabet, Google raising the bar for Facebook after the close.
We're going to try to give you some perspective, folks, this morning. And again, this goes on to Amazon, as I mentioned, tomorrow. John, Amazon, this is Joe Feldman over at Telsey Advisory Group. And again, this is a huge theme, margin expansion. Joe Feldman says you're going to look at operating margin at Amazon from 6.6% out to 6.9%. And he's got Amazon revenue in 2 years going from 281 gazillion out to $500 billion plus.
Yeah.
It's
hey, phenomenal, Tom.
It's something you can't really get a grasp.
Did you hear what Matt Miller said earlier? Analysts from now on, going into the quarter for earnings season, should just take the numbers that they get for the likes of Apple, Amazon, Alphabet, all of the above, and just add 20% to them, Tom, because we keep missing. We keep missing to the downside here.
What Steve Oth knows is about ratios, and what's so important here with the pandemic gloom, these juggernauts have kept their ratios and indeed even improved various ratios.
Let's bring in Steve Orr, shall we? Federated Hermes Chief Equities Investment Officer. Steve, how would you frame this? The analysts missing estimates or the companies beating them?
I'd put it as the companies beating them, John. I mean, it's just across the board. We're talking today about the tech numbers. They're just complete blowouts. But, on the cyclical side, what's making the S&P earnings continue to rise, we're all concerned about peak earnings. We're watching the consensus estimates on the forward S&P earnings for 2023. And those numbers are going up every day. The consensus is now above our number that we said several months ago, 235. At the time, it seemed like a huge stretch. We're going to have to bump our numbers again because it's not just the tech numbers that are blowouts. But if you look at the cyclical side of the economy, a lot of those companies are producing, earnings growth numbers above 100% here. Okay, off lower basis, but when you combine it together, the overall outlook for the broad S&P 500 is awfully good right here.
Steve, I want to talk about the famed Austrian extrapolation, which is anybody with gray hair knows you've got to look out into the future. How far out can you extrapolate this tech miracle? Product development, margin sustainability, revenue growth, and on and on. Do you have the courage to go out how many years? 2 years, 5 years? Can Steve extrapolate out a decade?
I could look out for a decade, Tom, and say the economy is going to be significantly bigger, probably at least 30% bigger than it is today, right? And the earnings numbers are going to be a multiple of that. So you could take that view and, you just stay long equities. But we're trying to, in terms of how we price stocks and think about stocks, we're thinking about 2023. We think that's where the puck is heading. That's going to be the 1 year out soon enough. We're in the back half of this year, and people are going to start looking to that. We've been looking to that for a while now, and that's why I keep, coming back to those numbers. But we look at this economy. For instance, I know there's a big debate about, our peak growth here. This is one of the problems that I think Wall Street has gotten fouled up here with the economic activity that's going on, is they're all, including the Fed, in my view, they're all using models that are traditional models. But this has been a very non-traditional recession.
Yeah.
Usually coming out of a recession, you've had a very, you go into one because some sector of the economy is very weak. Financials, autos, something. There's a lot of pain and angst. There's a lot of unemployment that rises in those sectors, and it takes a long time to recover. And so you can talk about, coming out of there, and then you're looking for where the growth peaks out, and then the cycle starts to roll over. In this case, it's been kind of goofy. I mean, the economy was going strong coming into this COVID lockdown. Underneath the surface, it continued to run fine. And the numbers we're punching up right now are ridiculous. I mean, we've got nominal GDP growth this year of 10%.
Yeah.
We've got nominal GDP growth next year of 7.5%. But if you look at the underlying real GDP growth, like our numbers for 2023, which are above the street, but I think are probably going to be closer to right, they look aggressive, on a year-over-year basis. But if you just go back to 2019 and trend it out, you say to yourself, gee, even with those kinds of punchy numbers in the near term, by 2023, the trend growth over these 3 years here will be about 2.5% on the economy. That's not that courageous. And same way with earnings. Our earnings numbers are 235, as I said. We're probably going to bump them to 250.
Yeah.
But even so, you'd be looking at about 9% earnings growth on the S&P over the last 4 years. So, we're really just kind of getting back to trend here, which has been pretty positive.
Steve, and that's definitely the reason why a lot of people have a lot of conviction in the long equities call. Just sticking with the tech behemoths for 1 second and just quickly here. Are the strength that we're seeing in their earnings indicative of a broader strength in the economy and among various corporations, or indicative of a shift in the economy that is specific to these companies?
Both, right? I mean, look at Google. The strength there was in cloud, in advertising. That's a strength. What people are realizing with Google is it's both a lockdown play and a reopening play, because as people start to advertise more, the place to go is search, right? So And the cloud buildup is strength, CapEx. It's the new CapEx is tech across the economy, people building up their cloud businesses. So you're seeing a compounding effect here. I mean, certainly Google, one of the three big cloud players now, has got a huge position, so it's getting a multiple.
And it's had a huge move this year as well, Steve. Just looking at the move, up by 50% year to date. Steve, it's unreal. It's great to catch up, sir, to run through some of these record-breaking numbers from the likes of Apple and others. Steve Orth, Federated Hermes Chief Equities Investment Officer. Apple down by about 1%. This is about the forward look, perhaps some supply constraints as well. But this was the line from Wedbush's Dan Ives, Tom. Called it a drop-the-mic quarter. Sticking with a 185 price target, goes on to say the top and bottom line big quote for the record books.
Jim Suva over at Citigroup, he takes 22 Apple, the operating margin expansion, John. Forget about all this gloom about margin shrinkage. Jim Suva goes from 28.8% out to 29.2%. They're doing this, John, with corporate responsibility and margin increase.
Apple trading at 145 at a pre-market. Wedbush looking for 185. We need to talk about this Federal Reserve decision. We're looking ahead to Chairman Powell. We'll do that at 6:30 Eastern with Nouriel Roubini of Roubini Macro Associates. Looking forward to that conversation. Futures up 7, advancing 0.16%. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. On this Fed decision day, this is Bloomberg.
With the First Word News, I'm Laura Wright. Federal Reserve Chair Jerome Powell and his colleagues are likely to emphasize patience today on scaling back the central bank's massive policy support. Policymakers are almost certain to hold interest rates near zero at the end of a 2-day policy meeting. The Delta variant is seen as giving Powell another reason to be cautious. Deutsche Bank rode out a slump in fixed income trading better than its peers. That's led the German bank to raise its revenue guidance. Fixed income trading fell 11% in the second quarter, beating estimates and some of Wall Street's biggest investment banks. Meanwhile, Deutsche Bank scrapped a cost target after a series of unexpected expenses. The British government is about to end the quarantine for visitors from the US and the European Union. That's if they've been fully vaccinated. Instead of isolating now, those travellers would have to take COVID tests before leaving for the UK and after they get there. In Australia, Sydney's month-long lockdown will be extended by at least another 4 weeks. Authorities have failed to flatten an outbreak of coronavirus cases that today surged to another record. The slow vaccine rollout has exacerbated challenges from new strains of the virus. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
Sem se apresentar, as escolas estão começando a reabrir, os teatros não vão reabrir tão cedo. Aí a gente teve a ideia, no melhor estilo do Milton Nascimento, vamos levar a música aonde o povo está.
Minha missão hoje é fazer as pessoas sorrirem, cara. Sorrirem, olharem da janela, verem uma coisa inusitada, ficarem felizes, mandarem para os amigos e, enfim, curtirem um momento diferente, mesmo dentro de casa.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Will you require all federal employees to get vaccinated?
That's under consideration right now, but if you're not vaccinated, you're not nearly as smart as I thought you were.
Would you require federal employees to get vaccinations? The President of the United States open to that suggestion. There has been a shift in this country over the last week. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. On this Fed decision day, here's the price action. Equity futures rolling over just a little bit in the last 20 minutes. Now unchanged on the S&P this Wednesday morning. Outside of that, Tom, yields higher by almost a basis point to 125.10, and euro-dollar unchanged, 118.12. Euro-dollar comes in 0.04%.
On a 125 10-year and on the VIX at 19.04, John, to me it's massive stasis before the meeting. Or Michael McKee, of course, will be in that meeting. Right now, Anne-Marie Horton, Bloomberg Washington correspondent. Anne-Marie, who's in charge? The Delta variant, I'm lost. I don't know who's in charge. I don't think President Biden knows who's in charge. Who's in charge? You got all the answers.
I certainly don't have all the answers when it comes to the pandemic, Tom. It really does feel like we're constantly 2 steps forward, 1 step back. I think the president would say that the CDC is in charge. This administration says they want science to guide it. What the CDC says is that they are reversing that decision from just 2 months ago, that you are, if you're vaccinated, can take off your mask. Now they're saying if you are indoors, you should be putting it on. There are breakthrough cases, and you could potentially carry it to unvaccinated people. And that's really where the problem is. It's the unvaccinated community, and already we see the Biden administration potentially weighing a mandate for federal workers to get vaccinated, and we're seeing a number of companies, including the Washington Post, here in D.C.
Anne-Marie, can you give us a sense of the mood in Washington, D.C., how much pushback President Biden's administration has gotten after this directive came out yesterday, a recommendation to wear masks, even if vaccinated in certain areas? A lot of people accusing it as confusing and a reversal of a mandate or recommendation just a week ago. How much pushback is there?
Well, a lot of people are saying, why is it happening now? And the Biden administration's answer is, well, the CDC is seeing new data and they're seeing new science, which the CDC has also said. But clearly this is a ton of pushback politically as well from the Republicans. And it's not just the White House that is now also mandating that if you're vaccinated and you work at the White House, you have to put on a mask. Also, we have the top physician at Congress saying if you're on the floor in the House or you're in the hallways, you need to wear a mask. And you are seeing plenty of pushback from Republicans saying saying there shouldn't be mask mandates, there shouldn't be vaccine mandates, and they just don't want to go backwards when it comes to having to mask up or potentially forcing people to get a vaccine.
Meanwhile, there are a number of recommendations that the U.S. should just finally give full authorization to these vaccines that could expedite some of the mandates and, frankly, on a more fundamental level, confidence in the inoculations. What's the time frame for that?
Yeah, we're still waiting for the full-on FDA approval. I believe the president said we should get it before the fall, the end of the summer. That potentially would give a little bit more impetus to the federal government or some of these private companies to mandate the vaccine, because some people are saying they're hesitant to take the vaccine because it's not a full FDA approved. It was just an emergency approval. Potentially that could nudge some of these individuals that are still quite hesitant to take up the jabs.
What are you looking for in infrastructure today? I mean, I understand we're completely transfixed by January 6th. We've got a pandemic that's making its way forward hour by hour. Is infrastructure sort of lost its way, or is it part of your Wednesday today?
It certainly hasn't lost its way. What I'm looking for, Tom, is a deadline. They've come and gone, these deadlines. The negotiations are continuing. We have the White House meeting with top Democrat from Arizona, Kyrsten Sinema, yesterday. She's one of the negotiations, bipartisan deal. They are, the senators, preparing to potentially work through the weekend. What I would like to hear now is what is the new deadline to potentially get this bipartisan deal on the floor?
I mean, that's really important. I mean, Senator Schumer spoke of nobody gets to go home, which is like serious talk in your Washington. Do you know that, Emery, now that you're doing the Washington gig, you get to take off the month of August? Did they let you know that?
Well, that's the gig as well in Europe, Tom, so nothing has really changed
that's
for
true.
me.
Nothing. John, that's so true. I mean, nothing has changed for Anne-Marie.
I miss it greatly. Anne-Marie, deadlines, do they even matter in Washington? Aren't deadlines just the same as Europe too? They don't really exist.
Well, you'll hear constantly, same as the European Union or Brexit, here in D.C., you'll hear constantly it's time for crunch time talks, deadlines, etc. But lawmakers do want a break. They do want to go home in August. There is somewhat of a deadline as well in the sense that we do have the debt ceiling approaching. There are other issues that are being held up right now because they are trying to work on this bipartisan infrastructure agreement, not to mention the Democrats really want to get it done so they could start working on their big plan, which is that $3.5 trillion soft human infrastructure package.
Anne-Marie, good to catch up. Our Washington correspondent down in Washington, D.C., Anne-Marie Hordern. This is not a trick question, guys. Hands up who is waking up in New York City this morning if you know the answer as to whether you should be wearing a mask indoors or not. Has that been mandated? No clue, Tom. No clue?
Yeah,
I've got no clue either.
I decided last night, and I failed this morning when I left the man's. John, I got to start carrying a mask again.
Lisa,
I'm not there yet, but that's where we're heading.
I was reading a lot about this, as you can imagine, because that's what I do in the evenings. And the justification here is that they found new scientific evidence that people who are vaccinated can transmit the Delta variant to unvaccinated individuals. So I do have a child at home who is too young to be vaccinated. So probably I would fit into that characterization because New York was in that bucket to wear a mask indoors. I mean, basically, if you look at the guidelines, yes, I would be required to wear a mask.
So you've got to wear a mask in your family home around your children?
Not in my family home, but outside. But outside,
when you go outside,
when I go out indoors in different locations, because if I could conceivably contract the virus and then transmit it to my younger son. So that, I think, is the rationale behind this. However, incredibly confusing. And again, what is the justification for getting inoculated if you don't have to change or can't change really anything?
So the rationale is one thing, Lisa. I think people fairly understand that. I think they understand that quite well. It's just trying to get their heads around what they're meant to do, whether it's been mandated or not.